Moneycontrol Mutual Fund Summit, targeting 100 trillion.
Everyone, good evening, ladies and gentlemen, and a very warm welcome to the first edition of Moneycontrol presents the Mutual Fund Summit. I'm your host, Karunya Rao. Today's event is co-presented by KFin Technologies, Associate Partner Reliance Industries Limited, Exhibit Partner Abhi Loans, and our event partners are Mirae Asset Financial Services, Canara Robeco MF, Union MF, White Oak Capital MF, FundsIndia.com, and Edelweiss MF. Let's start with a big round of applause and thank you all who has made time to be here with us for this very exciting event today. All right, now coming to the event. India's mutual fund industry today manages around 40 trillion rupees. Thanks to this tremendous growth in the last 36 years, investors today have many more opportunities to diversify their portfolios. The next milestone, of course, is the 100 trillion mark. However, there's still some time to go. Our mutual fund industry has, in fact, grown by leaps and bounds over the past decade. Changing along with it at multiple levels are the contours of the industry, the participants, products, and policies. And on that optimistic note, let's kickstart the summit. And for that, I'd like to invite Binoy Prabhakar, Chief Editor of Moneycontrol, for the welcome address.
Good evening, everyone. I want to begin by thanking all of you for making it in large numbers to the first Moneycontrol Mutual Fund Summit on a weekday evening. We are thrilled to have with us Mrs. Usha Thorat, Chairperson of the SEBI Mutual Fund Advisory Committee and former Deputy Governor as a guest of honor, and Mr. Ananta Barua, whole-time member SEBI, as the chief guest. Welcome to the summit, Mrs. Thorat and Mr. Barua. We're delighted to have the who's who of the mutual fund industry, fund managers and CEOs who manage assets of hundreds of thousands of crores gathered here today. This is a testament to their support and encouragement for our initiative. Thank you all. We believe that this summit is happening at the right time. There has never been a better time to talk about the future and aspirations of the Indian mutual fund industry, which is getting ready to touch the rupees 40 trillion mark. We hope our summit will provide a platform to assess the journey so far and look at what lies ahead. Through the summit, Moneycontrol, India's largest financial news platform and the flagship digital platform of the Network 18 group, aims to raise vital issues, trigger conversations, encourage debate, and share knowledge from some of the industry's marquee leaders, chief executive officers, and fund managers, as the mutual fund industry in India aspires to go from 40 trillion rupees to 100 trillion rupees over the next 5 years. The summit reflects the core values of our journalism, the urgency, creativity, and quality with which Moneycontrol approaches topics that matter to our audience. As many of you know, few cover the mutual fund industry as a Moneycontrol personal finance team. We review new offers, we analyze the shifts, and we connect the dots for our audience. If you haven't yet, I urge you to check MC30, our specially curated basket of 30 mutual fund schemes that are worth investing. Retail investors will be the centerpiece of the summit. We hope to find solutions to safeguard their interests, protect their investments, and encourage more of them to invest in mutual funds to secure their future. Ladies and gentlemen, enjoy the sessions and the insights. Thank you again and welcome.
Thank you, Binoy. Before I call upon our chief guest on stage, let's quickly take a look at the journey of mutual funds in India.
The Indian mutual fund industry is turning 36. From a recovery mode, it has moved on to become a trillion INR opportunity. And the momentum is right to assess our vision for its future. Moneycontrol Network 18's flagship digital platform for financial news has always endeavored to bring the mutual fund industry closer to its consumers. With its wide reach and association with industry experts, it has also been a knowledge-sharing platform that breaks down the fundamentals of mutual funds, encouraging the common man to transform into a confident investor. Now, as we step into a new year, we are getting ready to rethink, revolutionize and rebuild the roadmap towards becoming a 100 trillion INR industry with the launch of Moneycontrol's Marquee initiative. Moneycontrol Mutual Fund Summit targeting 100 trillion. An extensive platform where we shall deep dive and ask questions that must be answered. Spotlight the most enlightening conversations that become turning points and unravel new learnings to invigorate the industry and transform challenges into opportunities. Through meticulously planned sessions, the Indian mutual fund industry's marquee leaders, visionaries and the biggest decision makers from the mutual funds and investment fraternity will bring forth through conversations and panel discussions the Indian mutual fund industry's biggest highlights that scrutinize challenges and opportunities before the Indian mutual fund industry as it aspires to go from 40 trillion INR to a mega 100 trillion INR industry. Through this congregation of the industry's sharpest thought leaders, we will be seeking solutions to safeguard the interests of retail investors and encourage investments in the right mutual funds to secure their future. Moneycontrol Mutual Funds Summit will also shed light on new fund houses. What do they have in store for the retail investor and how they aim to differentiate themselves from their larger, well-established peers. So let's explore the potential our industry encompasses and initiate enlightening conversations to realize our vision of a 100 trillion INR industry. Moneycontrol Mutual Fund Summit targeting 100 trillion.
All right, let's get to the event. I would like to welcome our chief guest, Mr. Ananta Barua, whole-time member SEBI, for the welcome address. Mr. Barua handles the Legal Affairs Department, Inquiries and Adjudication Department, Market Intermediaries, Regulation and Supervision Department. As one of the 4 whole-time members at SEBI, Mr. Barua also oversees mutual funds. Please give a huge round of applause and a warm welcome to Mr. Ananta Barua.
Good evening, everyone, and also all the participants and who's and who of the mutual fund industry. As you know, the mutual fund story in India started in 1963, and UTI was the first mutual fund, and after that, the public sector banks and insurance company, they ventured into this field. In 1993, in 92, SEBI was born, and in 93, one of the regulations which was framed was mutual fund regulations. And for the first time, the door was open for the private mutual fund also. And there is a full level playing field both for the public sector and the private sector. There is no discrimination at all. And today, we see there are a large number of private mutual fund players who are in the industry. And recently, there was a news that even the central government, they have decided that the CPSC, that Central Public Sector Undertaking, they have also been allowed to invest their surplus fund through the private mutual fund. This shows that the government and especially if you see also EPFO, they also decided to invest through ETFs. That means government and all, they have a faith in the mutual fund industry. And the structure which was ushered in in 93, as you know, it was a trust structure where there is a sponsor who sets up a mutual fund, and then there is a trustee, and there is a asset management company. The trustee holds the assets on behalf of the unit holders, and there is an agreement by which the asset management company, they manage the assets for the unit holders. That is the structure which has been laid down. The structure is totally bankruptcy remote. That I will come afterwards. The thrust of the regulations, if you see, there are many, if you go through the regulations and the framework which is laid down, is based on 5-6 principles, mainly disclosure and transparency, ease of investment for the mutual fund, and to provide a low-cost vehicle and risk diversification, liquidity, then prevention of mis-selling, and avoidance of conflict and alignment of incentive. As far as the transparency and disclosure is concerned, the theory is that the sunlight is the best disinfectant. And mutual fund, if you see, is one of the product. If you compare it with the other banking and other, if you take example for the loan and all. In case of mutual fund, there is a daily disclosure of NAV and total expense ratio. And there is also disclosure of monthly portfolio a mutual fund is holding. As far as debt funds are concerned, they have to disclose their portfolio fortnightly, along with the underlying yields of the instruments. Earlier, only they were required to disclose only indicative yield. And they have to also disclose the distribution commissions which a mutual fund is giving to sell their product. Then there is also disclosure regarding the remuneration of the executive, KMPs. And they are sitting here, and they have to justify the money they are taking for managing the fund, and whether they are able to beat they are active enough to beat the benchmark which they have to disclose. That is the disclosure of scheme performance. And then they have to also disclose the large unit holding, if anyone is holding more than 25%, and also other, just like complaint, then there are annual and scheme state accounts and other disclosures are there. And there is one more disclosure which I have to make, that whatever I am speaking here, it should not be attributed to SEBI. And as I said, there is a lot of focus on ease of investment. I don't want to go, and I think especially media and others, they have taken a lot of steps which I think retail investors, they are aware of, and that's why we see the number which have swollen. As far as the folios are concerned, the latest figure shows that it is more than 13 crore. And if you see the unique, I think it is across more than 4 crore. The other thrust of the regulation is the fair treatment of the investors. And mutual fund is a product, especially the open-ended, where the investors can come and go anytime. And it compares with even the bank, where you have, especially if you want to withdraw money anytime or want to deposit money anytime. And this we have seen especially in case of COVID, and when the large number of retail investors, they flocked into, if due to some, as you know, during the COVID, there was a lot of activities which were suspended, and many citizens, they did not have alternate money, which just like some employment in case of hospitality or airlines and all. So people, they money which was kept in unit mutual funds and all, and there was a redemptions and other thing, and mostly all of the our mutual funds, they were able to meet the redemption pressures. Earlier, as far as the NAV was concerned, for withdrawal of money, there was two rules, depending on the size. If it was less than 2 lakhs, they were getting the NAV of the day, and depending on the size of the amount also, there was some differentials. What SEBI did, there is a now uniformity of applicability of NAV. The units are allotted at the closing NAV of the day. The money is credited to the bank account of the scheme, irrespective of the size and time of receipt of such applications. And we have seen, especially during COVID, what happened, there was a large inter-scheme transfer. What was happening actually, the short duration fund, debt schemes, because they were not able to, in some cases, liquidate their illiquid securities. So those things were being transferred to the other long-term or balance fund and all, and there was an inter-scheme transfer. And this was to the detriment of the unit holders of those schemes. Then what SEBI did, then there was a stoppage of this inter-scheme transfer. And now the rule provides that any such transfer has to be done at prevailing market price for quoted instruments on spot basis. And then the transfer should be in conformity with the investment objective of the scheme. And secondly, no inter-scheme transfer if there is any negative market news or rumor about the security or their downgrade. And one more thing which has been introduced, if you know, in case of a debt scheme, if there is any stress, so there may be large redemptions. And then a new concept of swing pricing has been introduced. And in these cases, what happens, the redeeming shareholder has to bear that expense instead of the unit holders who remains in the scheme. Similarly, the mutual funds, they have been given options. We know, especially in case of debt schemes, they may have a portfolio, and some portfolio may not be that liquid. They may not be able to sell. So the option has been given to them. They can segregate that portfolio. Even if those portfolio which has been segregated, even if a investor has exited the scheme, the investor still, he has the right to receive proceeds of return of bonds at a later period, even if they have left this fund. And there is a lot of thrust on prudential and diversification of the scheme portfolio. And the whole thrust of the regulation is that the mutual fund shouldn't, because being a trustee and fiduciary, they should not gamble with the money of the investors. And for that purpose, some limit has been laid down. Limit in case of issuer limit, group exposure limit, own group exposure limit, sector exposure limit. As we have seen that sometime during the stress time, especially in the COVID, some sector came into the stress. Actually, what was happening due to COVID, some moratorium was allowed in the repayment of loans and other things. And therefore, the NBFC, they were not able to get their regular repayments from their borrowers. And in turn, they were not able to pay to their investors, from whom they have, who have invested in their bonds, like mutual fund. So what was happening, there was a cascading thing. There was no payment from the borrower, then NBFC in turn was not able to pay to the mutual fund. And there was, a situation was arising where there was a difficulty in some cases in giving redemptions and other. And to take care of such that there is the exposure of the mutual fund is to a particular sector, do not cross a limit, sectoral restrictions has been laid down. As I said earlier, as far as the mutual fund is concerned, you can see the whole portfolio. In case of debt, the instrument where they have invested, and whether that portfolio, how much is consisted of AAA, AA, and others. In cases when there is a redemption pressure, because all open-ended mutual funds are obligated to give and accept redemption request of the unit holders. And for that purposes, the regulations, there is a lot of thrust that there is no asset liability mismatches and the mutual funds are able to meet these obligations. And there is a requirement that all open-ended schemes, they have to keep at least 10% of their portfolio in liquid assets. And the liquid and other fund, they have to maintain at least 20%. And there is also requirement of stress testing and other. And there is a lot of thrust providing for, especially in case of debt, that as we know that debt is not that liquid as far as the equity is concerned. And a platform was made, that is request for quote platform, where the mutual fund and all the institutional investors, they trade. Basically, especially in case of debt, which are mainly the OTC product. And there was no platform where these instruments could be traded. This was all in telephone platform. The A framework was laid down through which SEBI mandated the mutual fund that at least 10% of their portfolio should be traded through this request for quote platform. For debt and for commercial paper, at least 25% in commercial paper through this request for quote platform. Similarly, many other schemes, and the government also announced in the budget that there will be a backstop facility. And provisions for that still has not come into existence, but a lot of work has been done. And this facility will provide for institutional mechanisms for a framework to purchase investment-grade debt securities both in stressed and normal times. And MFI has been mandated to come out with institutions and set up, that is limited purpose clearing corporations, where they will provide facility for trade in the repo in corporate bond market. And one more thrust area of SEBI is that the mutual fund should address all type of risk which they face. And the risk has been divided into, one is scheme levels and one is AMC level. As far as scheme-specific risks are concerned, the mutual fund has to provide and address all liquidity, investment, and credit risk. And in case of AMC, they have to provide internal mechanism and risk management control for operational risk, technology, information security, and cyber risk, reputations and conduct risk, outsourcing risk, sales and distribution risk, financial reporting risk, legal, tax risk, and talent risk. The compliance risks shall be applicable for both investment management activity and business activity of AMC. Actually, we have seen the industry or all, they see compliance as a burden, but we see it is a part of a business, because if there is a proper compliance with all the rules and regulations, and if it is properly addressed, what may happen, we may see that whatever violations which takes place, especially in form of front running, insider trading, or mis-selling, those can be addressed. And as you know, there is a lot of, especially the mutual fund as a product, we have seen in all type of media, whether it's a social media, whether it is a news, there is always discussions on the mutual fund products. Our main thrust is that there should not be any mis-selling from any quarter. And for that purposes, especially for the mutual fund, for the distributors and AMCs, SEBI has come out with the guidelines that there is a product leveling. The product should be true to level. And one example we can give is that of dividend paying scheme. Actually, earlier, the dividend in some cases were paid also from the capital. And therefore, they have been told to level their scheme properly so that the unit holders know that he's getting dividend whether from the actual investment return or from his capital. And the riskometer has been made dynamic, depending on the portfolio. If the portfolio, if there is because there is always, in some cases, sending a portfolio. If, depending on the portfolio, the quality of the debt paper may change, the risk may increase. So it has been made dynamic. And then benchmarking of scheme performance to total return index. And one more thrust area is that there should be avoidance of conflict of interest. And for that purposes, one example we have given that the remuneration of the executives and the fund manager should be such that it should not encourage unnecessary risk-taking. And they should also have a taste of their own pudding. And therefore, a rule which has been introduced is that skin in the game. So all the designated employees and KMPs, they have to also invest at least 20% of their CTC in the scheme of the mutual fund. And recently, the units of the mutual fund has been included in the definition of security under insider trading. And for that purposes, all the mutual fund AMCs, they have to come out with the internal guidelines where there will be restrictions on the designated employees for trading in the units of the mutual fund. And the mutual fund, especially, they have to lay down the rules, the closing period, opening period, how much they can trade in the units of the mutual fund. And there is a whole regulatory structure which has been laid down for proper supervision of the mutual fund. And it is basically in the three levels. One is through the trustees, who are the first level supervisor of the mutual fund. And the mutual fund itself, they have to generate a compliance test report monthly where they have to submit any exception if there is any violation of any rules and regulations. And that is monitored. Secondly, the mutual fund trustees, they have to come out with half-yearly trustee report, and which are also being analyzed. And SEBI also conducts inspections. There are two levels of inspections. One is on-site inspection, which is done periodically depending on some risk parameters. And there is also online automated inspections. And this is done on daily basis, and depending on the alerts which is reflected, generated, then those are analyzed, and accordingly, if there is any supervisory concerns, those are addressed. These are the basic thrusts of the regulations which I wanted to state. And often there have been, especially after the financial crisis, there was a lot of debate how the mutual fund industry others should be regulated. There one concept came which, especially in the West, they said whether this type of industry is like a shadow banking. In a sense, they are lending, but they are not subject to the similar requirement as the banks. But as far as India is concerned, we have a distinct framework. One is that the mutual fund in India, they are not allowed to give any assured return or guaranteed return. Everything is subject to market risk. No mutual fund can give a constant NAV. We have seen in case of USA, there was a concept of breaking buck. There was a constant NAV. If in case of money market mutual funds, the all retail, they were given constant NAV. And if it was below that, it was known as a breaking the buck, and the mutual fund was obliged to give that the amount, even if the NAV was below which was assured. So in India, it is all mark to market, and therefore no question of guarantee or constant NAV. And second thing is that in many countries, they are allowed to originate loans. But in India, mutual fund, they invest in the debt papers, and it is different from origination of loan. And one of the important things is that no leverage is allowed. In other jurisdictions, what they do, they borrow money in case of, if interest rates are low, they borrow and then they invest and give return on that. But in India, it is not allowed. There is a limited restrictions on borrowing. They can borrow only if there is a redemption pressures and all for temporary purposes. And we have a concept of fair valuations. What happens if there is a paper, debt paper, if they are not able to sell, if there is a downgrade, then the value which it fetches, that will be valued. And suppose a paper which is both held by a bank and also by mutual fund, and it is a secured paper. So, what will happen for valuation in case of banks, they will have some haircut because it is secured. But as far as the mutual fund, it will be fair valuation. It may be zero also. And therefore, the norms are totally mark to market, and the valuations as for the debt papers, there is a detailed guidelines has been laid down. And one more thing, as I said, if there is a run on a bank, take a cooperative and other thing, or any corporate entity, they are subject to IBC and all. But the structure of mutual fund is like that, all assets are held with the custody, a separate custodians. Even if a mutual fund goes bust and all, the fund will be, the security will be held with the custodian, and everyone can see that fund. The portfolio as I said earlier, that all the portfolio are required to be disclosed. And those portfolio no one can touch because it is held in trust. It is not subject to any bankruptcy because it is not in the balance sheet of any entity, the asset which has been held by the custody. So those, if there is due to some reasons, if any scheme is required to be wound up, the money will be paid from that security which is held in trust. With this, I wanted to end my talk here. I wanted to and thank all of you, and especially I wish that the topic of the summit, that within 5 years it should cross 1 trillion. I wish all you success. Thank you.
Thank you so much, Mr. Barua. It was such an inspiring speech. And now, ladies and gentlemen, please put your hands together for tonight's guest of honor, Ms. Usha Thorat, Chairperson of the SEBI Mutual Funds Advisory Committee and former RBI Deputy Governor. At RBI, where Ms. Thorat served till 2010, she saw the central bank through the challenging days of the Lehman crisis. She worked her way up at the RBI, starting from the dealing room in 1991, and also did valuable work on financial inclusion, including her tenure at the central bank. She also takes active interest in social issues. She's a trustee at the Indian Cancer Society. Please give a warm welcome to Ms. Usha Thorat.
Ladies and gentlemen, great pleasure to be here this evening. Thank you, Lata, for inviting me. Thanks to Moneycontrol for the invitation. Thank you, Mr. Barua. It's been such a journey you've taken us through, and I don't think anyone other than you could have summarized the entire gamut of regulations in such a concise, logical manner that I thought for myself it was really an educative experience. Thank you so much. I find the panel discussions are really well structured and well thought out, and I'm sure there's going to be a lot of very, very exciting and interesting. I look forward to the industry expressing its views very frankly and freely, and in the interest of investors and the industry. My understanding of this industry is very recent, and I can't claim any expertise or experience. But what I have seen in the last few years is very remarkable. Mr. Barua had summarized a lot of these years, but it has been a very, very eventful period. And what we have seen is this phenomenal growth in the assets under management. The post-COVID years, awash with liquidity and lower interest rates, facilitated by digitization, has seen a phenomenal growth of investors in the mutual funds, as also in the assets under management. The Reserve Bank quarterly data on household savings shows that the assets under management grew at bank deposits grew at 9.4% in the last 2 years, and insurance by 6.2%. Household investments in mutual funds actually grew at a CAGR of 32.3%. Mind you, this is not the growth in total assets under management of mutual funds, because that includes, that 40 lakh crore includes institutional investors. What I am talking about is just the individual investors. So the total assets under management, like we saw, it's a 40 trillion industry. The household investments constitute about half of that, 21 lakh crores. So this is remarkable indeed, and it is in the right direction of garnering more funds from households, rather than from institutions and corporates who are actually informed investors, and maybe they ought to be investing directly in the markets. The phenomenal growth also implies that the fiduciary responsibility of all of us is getting more and more important from the system's point of view, and this is something that we need to be responsible for and constantly aware of. SEBI and AMFI have taken a number of measures, and Mr. Barua has really gone through that, especially since the ILFS 2018 and then March 20 issues. making sure there's greater transparency to the investor, funds are not taking risk beyond the mandate of the investor, and there is a greater degree of risk management, and that their interests are aligned with those of the unit holders and conflicts of interest are avoided. Measures to deal with market-wide disruption and stress have also been initiated. And the earlier period was more a period that was sort of focused on changing the incentive structure that favored an upfront and a distributor-driven system to one that was focused on investor interest. But the last 5 years has been really on the issues that Mr. Barua. So I don't want to go through some of those issues which I have, but I think one issue which is definitely important is also on the voting by mutual funds, because they are becoming bigger and bigger holders in the corporate equity, and I think their role in the voting, I think, is important, and on that too, SEBI had issued some guidelines. Now, we think of mutual funds as pass-through structures, where the investor who does not want to invest in the market directly gives a mandate to the fund manager to invest according to her risk preference, and then is prepared to take the losses and gains as long as the mandate has been complied with. The investor also expects redemption when he chooses to exit the fund. And there have been anxious moments for mutual fund investors. We saw this, like Mr. Barua says, in 2008 we saw it. We saw it in 2013, and we saw it again in 2020. All-round drop in market liquidity, especially for bonds, creates the redemption pressure, net NAVs drop, triggering further redemption. So much so that even very highly rated assets did not seem to have an exit route for for them. And usually this happens when there is an overall crisis in the system, and what typically happens is that there's a huge pumping in of liquidity and to create confidence and prevent a spiraling downturn. So in a way, I would say that what has happened, and this is not true only in India, but also the entire world, that it's sort of the regulator's intervention seems to have become a costless option, writing a costless put option. And it is in this context I want to raise the first issue. Should we be looking at a roadmap for gradual exit of institutional investors from the mutual fund industry? I'm sure this is not at all welcomed by many of my friends from the industry. But when you see that mutual fund penetration is just 10% of household savings, there is clearly a need to focus on mobilizing more and more of those financial savings of households, whether it is in Tier 1, Tier 2, B30, or whatever it is. And therefore, we cannot be complacent just on the basis of the size of the AUM. I think the AMFI mutual fund Sahi Hai awareness scheme and the encouraging the B30, it's had good results. But there need to be incentives, and not incentives which get misused, for mobilization of retail investors. Institutional investors, I'm sure, provide liquidity. There are also lots of pluses, I'm sure, of having institutional investors. But they're also the ones who pull out normally in the moment of any information, and the retail investors are left behind. Thank God this swing price that Mr. Barua, referred to actually makes that, the kind of implication of that for those left behind a little better. And when there is a crisis, the measures, so in a way, life becomes very cushy for institutional investors. So whether we should really be looking at this kind of a roadmap is what my first question is. Now, ETFs and index funds are actually ideal for retail investors. The total assets in such funds has grown significantly in the last 5 years, in a multiple of 10 in general, and for individuals, it is a multiple of 15. Also, the AMCs are permitted to, while they're permitted to charge up to 1%, the actual expense that is being charged is as low as sometimes just 0.1 or 0.09%. But at the same time, these products do not seem to be, they have certain shortcomings. Maybe the pricing, there's a gap between the pricing and the NAV. There is a poor secondary market liquidity. And I think industry leaders, like all of you, have to somehow see that the infirmities in these markets and the way that retail investors come into those markets can be really increased. A second is a connected point, and this also Mr. Barua left to, is whether when we look at this two measures that have been announced, one is about the backstop facility, which will create a body which will both purchase investment-grade securities, both in stress times and normal times. And the other one is the setting up of the AMC Repo Clearing Limited to boost the liquidity in the bond markets and, in a way, really helping the mutual funds with the needed support. These two market microstructure measures, it's hoped, will become operational soon and can help the markets when under stress, particularly when the mutual funds are struggling to redeem. Now, these are all extraordinary interventions on ground of public policy. So whether they should really be available to institutional investors, which is inevitable because they are all part of the mutual funds, or it should be to the retail investors. The third issue, and this is something that Mr. Barua, in fact, very clearly brought out, that when the regulations were started, a mutual fund is established in the form of a trust. It is a three-tier structure. There is a sponsor who forms the trustee company, and the asset management company. The trustee holds the assets of the mutual fund in fiduciary capacity, and the asset management company is responsible for managing the funds in line with the stated investment objectives. At that time, as I understand, consideration was given to two major factors. One, that mutual funds are garnering a large amount of money from the public in a dynamic market. This required specialization on the persons performing the functions, reducing the cost, and also ensuring potential conflict of interest is avoided by ensuring an arm's length relationship between the various functions. So this is, the three functions are there, but the primary responsibility for the oversight is that of the trustee. And it is in this context I have been sort of thinking whether there is a need now to have a better clarity on the role and responsibilities of the sponsor, of the trustee company, and the asset management company, so that the accountability for any wrongdoing or any violation can be clearly laid at the floor, I mean, at the instance of any particular entity. One is, of course, overlaps, the other is gaps, and also the question of overburdening these entities with so much that do they lose their focus. So I think this is a matter on which I feel that a summit like this is something which can look at it. So there is the role and responsibility of the sponsor. Now, there are huge variations in also this, because it depends on the nature and the size of the sponsor. The largest mutual funds, and many are here, are invariably sponsored by large financial conglomerates with deep pockets. There is merit in this, because in terms of financial resources and in terms of talent, sponsors are able to give the needed support to the AMC and even provide them with liquidity in stress times. From the investor's point of view, it's a holding out. The holding out by such sponsor, even without legal liability, it provides huge comfort. And many retail investors sometimes actually feel that the name which is going with the mutual fund gives them a lot of confidence. And so they feel it is like as good as investing in, the bank itself. So from the regulator's point of view, and I'm taking a little aside now and getting into the financial regulator for the system, so let me digress a little bit, I hope you don't mind, that there is a holding out risk, all said and done. And this is called, in Basel terms, a step-in risk. So how do they define it? It arises to avoid the reputational risk that a group might suffer were it not to provide support to an unconsolidated entity facing a stress situation. There is a framework under what is called the Financial Conglomerate Supervision Framework, where such risks are expected to be monitored, such risks expected to be addressed. It is a financial stability issue and will be probably the FSDC is the most appropriate forum. But there is, I'm linking it here because it's linked to the role of the sponsor. So come back to the role of the sponsor. Sponsors have, in many cases, divested a good bit of their holdings. They're independently listed on the exchanges. So should we really de-link the AMC with the sponsor? And the sponsor's role and responsibility taken on by the AMC itself. From the system's point of view, the investor will rely on the transparency that is available, and there'll be probably more level playing field vis-a-vis smaller funds who don't have a big name behind them. Anyway, there are pros and cons, and I think this is something that is constantly discussed, and it probably needs much more debate. Next, let's turn to the role of the trustee company and the role of the AMC. The trustee's primary responsibility is to have oversight, to ensure the funds is invested as per mandate and true to label. Now, possible conflicts of interest are disclosed and addressed. And I would say that in financial sector behavior and regulation, the thing that really triggers problem is usually conflicts of interest. Now, where conflicts of interest will come from and how you will start monitoring them and looking at them cannot be laid down in any manual or rule book. It is something that it's the role of the independent directors, both on the asset management companies as also the trustees, to really ask the right kind of questions that possible sources of conflict of interest are brought out and addressed. So clearly, when having the trustee structure, it provides an oversight. It acts as supervisors, like you said, first-level supervisors, and it also monitors the compliance and ensures the investors. The opposite way is that there is a lack of financial and operational independence, and that could hinder efficient discharge of duties. Main way that independence is being ensured is through having that independent directors and having one person exclusively to attend to and that was also something quite recent, to the trust company who will be giving all the information. So, but then there can be situations where they could be, they may not be the kind of independence that we are really looking for. In the case of the AMCs, the basic responsibility to see that it's compliance. It is to see that the funds are invested according to the mandate, there is true to label, there is full transparency, valuation is done as per the guidelines, and having a dynamic, evolving risk management strategy. That, I think, is something that Mr. Barua, in fact, clearly articulated the various risks at the level of the AMC and at the level of the scheme. So, while reviewing these role and responsibility, I think what I'm trying to say is that we have to have clarity about the accountability without undue overlaps and gaps, freeing the trustee of many of the operational and compliance functions that can be done on the basis of assurances, and making the trustee focus on its main role, and also making sure the AMC, is strengthened to take on this role of, in the eventuality the sponsor not being there, and also many of the things which is currently we are expecting the trustees to do. This can also reduce the oversight, the cost of oversight and compliance. Of course, like I said, it will call for highly professional and independent directors who can smell the sources of risks. I have been suggesting that maybe we should have periodic conference of independent directors of trustees who can really, get together and discuss issues of current concern. A fourth issue, of course, it's continuing with the conflicts of interest. There are cases where the possibility of conflict of interest is more, especially when the AMC is part of a larger financial conglomerate, which has a bank, an insurance company, a merchant bank, other financial entities in the same group. It should not happen that the investor, that is the unit holder, is pressurized into acquiring assets through the AMC where there could be pressure by the group companies. It could happen when mutual funds are invested, could happen where, in particular where mutual funds are investing in the primary market, in public issues or in privately placed debt securities, where the merchant banker, there could be possible pressure. There could be situations where a near default but rated security is passed on to the fund. So can we call this mis-selling? Can we call this conflicts of interest? What do we call it? We have also seen sometimes at a retail level, you walk into a bank branch wanting to make a deposit, you come out either with an insurance or a mutual fund policy. So, I mean, these are some things that is inevitably a part of this cross-selling kind of a business. A final point which I want to make is the objective of regulation and the manner in which rules and regulations are interpreted and enforced. Apart from the fact that there should be a clear accountability and the right person is penalized, one cannot be quibbling with the wording of the regulation when it's very clear that the investor's interest has been clearly compromised. When wrongdoers are punished and regulators has the authority to do so, after establishing that the investor's interests were compromised, needless litigation appeals only go to weaken the regulation. And I think as a system, we have to be very conscious of this. And we sometimes end up generating more and more regulation. More rules are written to address those very infirmities which were challenged. This is not productive at all. So we have to very often we tend to forget that regulation is useless unless there is adequate supervision and ability to enforce. It is that enforcement which is actually going to make the system safer. It will, if we all act in that spirit of regulation, the cost of regulation to society will be much less. Thank you all very much.
Thank you, Ms. Thorat, for those splendid words. In the past few years, India has seen an explosion of growth in the mutual fund industry. The growth is primarily due to the growing population and increasing wealth of the country. Money invested in mutual funds becomes an extra source of income for people, and this has led to a rise in the number of people willing to invest their money in mutual funds. The Indian mutual fund industry has changed significantly over the past few years because of two factors. It has become more accessible for people across all social classes than ever before, and people are starting earlier than ever before so that they can take the advantage of better returns from investing early on. But the journey from 40 trillion rupees to 100 trillion rupees doesn't come without its challenges. Investor expectations, performance pressure, and new and emerging market complications, to name a few. But how does the industry cope with these roadblocks and turn them into opportunities? Well, now that we've warmed up, it's time for the first discussion of the evening, the CEO panel. And to moderate this panel, may I invite on stage Kaizad Adajania. He's the Assistant Executive Editor, Personal Finance Moneycontrol. And along with him, Navneet Munot, MD and CEO, HDFC AMC. Neil Parikh, CEO, PPFAS AMC. Radhika Gupta, MD and CEO, Edelweiss AMC. And Nilesh Shah, MD, Kotak Mahindra AMC.
Hello. Oh yeah. Just remove the badge, it will hamper with the mic. Okay. Why? Because disclaimer is not written here. Okay, hello and good evening and welcome to the first panel. We're walking the mutual funds journey from 40 trillion to 100 trillion. Now, Karunya obviously set the context of the panel, but I'll just add my 2 cents more. Most of us who've been in this industry for long, we've been told and we've listened to several people saying that, mutual funds is a nascent industry, the Indian mutual funds industry. For long, that word nascency was attached to the Indian mutual funds industry. But today, when the industry AUM is about 40 trillion, every month about 13,000 crore worth of money is coming through SIPs. You can't say that industry is nascent anymore. In 2017 and 2018, if you see, the AUM of mutual funds was about just 17% of the overall bank FDs. Today, it's about 26%. Yes, the gap is closed. It's not that close, but it's definitely closed down. And even if you compare the AUM of mutual funds as far as insurance is concerned, there has been a tremendous progress. So, we can't say now that mutual funds is a nascent industry anymore, which means that the journey from 40 trillion to 100 trillion is going to be challenging. It's going to be different. AMCs and fund houses will need to sort of alter the way they think to go ahead. Why? Because the markets are getting complicated. Products are also getting complicated. New kind of products are coming in the sense that, mutual funds today are getting competition not just from passive funds. They are also getting competition from AIFs, from small case, and from PMS. So how is the industry slated to walk this 40 trillion to 100 trillion? What are the new opportunities and what are the new challenges? That's what we're going to be discussing today. So Radhika, Nilesh, Navneet, and Neil, welcome to the panel. And Nilesh, let me start by asking you. We'll deep dive into specifics as we go along, but just to set the context, give me one big challenge, one big opportunity for the Indian mutual funds industry from 40 to 100 trillion.
The challenge is to add value to my customer. Like in last 30 years, we have added value. Next 30 years, I have to add value. If I don't add any value, I won't be here. That's my challenge. The opportunity is that I have reached today to about 4 crore investors. There are about 25 crore Indians having two-wheelers. And there are 140 crore Indians who has need for financial security. How do I go from 4 crore to first 30 crore and then to 140 crore? That's my opportunity. Mutual fund is the most transparent, most cost-effective financial security provider. I need to reach out to 140 crore Indians.
Okay, so basically to service, to give value to your customers is obviously going to be, you're saying that's going to be a big challenge because you've given some amount of value so far and you have to keep up with the pace in the next 5 years or 10 years or so, also as you reach 100 trillion. But, to be able to do so, Navneet, is it fair to say that, AMCs have to be sustainable? Profitability growth, because this is when we speak to so many AMCs, especially, of course, you guys are the big daddies of the world, so you've been around for like 2 decades or so, but, the newer size, the mid-size AMCs, the small size AMCs, it takes a lot of patience to remain in this industry. So, profitable growth is important, but, so many passive funds are now being launched by mutual funds industry because one, regular rising popularity. Number two, SEBI has also set the categorization in order so that you can't launch more than one active scheme per category. So the only way for you all to grow is to launch more passive funds, more ETFs, more thematic funds as far as your products bouquet is concerned. So I'm just wondering, with low costs, products, how will AMCs be able to sustain profitable growth to be able to serve the customers better?
So for growth in our business, you need 2 things. Number one, the value system which is needed for success in this profession. So as you said, you are the big daddy today, but we were a small startup in 1999. We were the 26th AMC on that day. Our license number is 44. Over the years, I think it's a value system that has made us where we have reached. The second thing you need is the right economics for the business. And if you combine these two, I'm sure given the growth potential that Nilesh talked about, there is a lot of opportunity for all kinds of people. As long as you have the right value system, you think about the client first, you have the compliance and risk consciousness that Mr. Anant Barua alluded to quite a bit. I think we have the right kind of transparency, the highest standard of ethics, and always thinking about am I adding the value to the client? And also not only focusing on the product alpha, but over a period of time for growth, we need the solutions alpha. How do you provide the right solution to the investor rather than just generating alpha on the product? But I'll just tell you about, just a point that Nilesh mentioned earlier about now we have reached 3.7 crore unique investors, 14 crore accounts. And you also mentioned that number, 17% of bank deposits. So our industry was 10 lakh crores in March 14. We were 20 lakh crores in 2017. We were 30 lakh crores in 20, and we are 40 lakh crores today. It looks like a massive growth, but almost this entire growth is from equities. The equity AUM has grown from 2 lakh crores to 20 lakh crores, which is a combination of investors investing more, SIP AUM that has grown to now over 6-7 lakh crores, and also the mark-to-market gain. If you compare the banking industry, and I'll just make a point on what Mrs. Thorat mentioned about the institutional money. The bank deposits crossed 100 lakh crore number in September 2016. Bank deposits today are 170 lakh crores. When bank deposits were 100 lakh crores in September 16, the fixed income AUM of mutual fund industry was 10 lakh crores. We were 10% of bank deposits. Today, 170 lakh crores, and we are 13 lakh crores in the fixed income and in liquid. Even if you add a little bit of that GSEC index that has got added, but then you have to see the size of growth of the overall GSEC market. We are actually shrunk as a percentage of bank deposits. I repeat, we have actually shrunk as a percentage of bank deposit in terms of our growth over the last 5 years or so. There is tremendous potential there for us to grow there. Equities have done well, but as Nilesh bhai mentioned, we are still 3.7 crore people, so we have a long way to go. But it takes a lot of time for an industry to reach a certain stage, and going back to that economics of the business. So it took us almost 20 years of that hard work of SIPs and power of compounding over a long period, etc. The next 5,000 crores came in the next 2 years. But I think over the next several years, now we have reached 13,000 crores. Over the next several years, I think this is where our big focus would be. How do we get more and more investors who understand the long-term power of compounding, stay with us for the long term, and we, as an industry, together, we focus on solution alpha, and at an individual AMC, all of us focus on the product alpha.
But Navneet, a lot of that growth which you said came in the last 2 decades also came because of product launches. You kind of launched so many funds across the different spectrum, which actually led to categorization. My limited point was that,
No. You know which is the largest fund in India? SDFC Balance Advantage Fund, close to 50,000 crores, is the oldest product, was also one of the oldest product in India. And same is the case with all the other products. I think large part of the money is coming into those products. The other day I was speaking at an event and they were asking about the innovation. I said the innovation is Mutual Fund Sahi Hai campaign. The innovation is in the communication. The product innovation is playing a very small role in for us to grow the market. In India, where large number of investors, if there's 170 lakh crores of bank deposits, to those investors, we just need to go and provide an instrument which can beat inflation, which can deliver better than the bank deposits. And how do you ensure that the investor understands that product?
Okay. Radhika?
And by the way, don't get me wrong. So product innovation has a role to play. There would be different kinds of investors. In last 3 or 4 years, international funds have grown to from hardly anything to $7 billion, right? We hit the limit. There are investors who are looking at PMS. There are looking at alternative funds. There will be, everything will grow given the size of the opportunity in India. But bulk of the growth for next several years, all of us are mainly focused on how do we get the next, to us, out of 1.4 billion people that Nilesh bhai talked about, the total addressable market in the near term is maybe anywhere between 10 to 15 crore. I think the next 6 to 10 crore investors, bringing them through an SIP, simple product, I think is where our industry's efforts are directed at, and we'll continue to work hard at.
Active and passive funds, both.
All put together. I think, large number of investors are yet to meet the market. We focus a lot on beat the market. And as I said, that focus on solution alpha, the investor alpha is a lot more important than product alpha. We have to justify our fee. We have to deliver that alpha. For that, we have to do everything that is needed for that. But at the same time, the bigger need in the industry for all of us to work together is to get that investor. No. Also, again, slightly digressing about this whole cost of the active and passive. And when you compare the passive, you are comparing with the total return index, but you don't get the return, right? In an ETF, ETF, if you add all the other cost and the impact cost of buying and selling versus the transparency that you are getting in an actively managed fund with that fee, I think they will beat them hands down any day. I mean, the active will beat them hands down.
Yeah. Shrikant, please come to the panel.
Maybe if I can, Mrs. Thorat mentioned about that institutional investors. Ma'am, I was managing the first liquid fund in India, and it took us several years of convincing corporates for us to reach 100 crore size. And today you mentioned about 21 lakh crore come from institutional, from individual investors, 19 lakh or whatever odd is from the institutional investors. A good part of that is also the EPFO and the pension fund money. Apart from that, corporate money is mostly in the liquid and the short-term money market. On the equity side, almost 90% of the money is from individual investors. On the contrary, globally, if you look at the asset management industry, large part of their AUM comes from pension fund, insurance companies, banks, local government, large part of the institutional investors. In India, we have no access to most of this institutional money. Hardly any institutional money comes to the mutual fund industry. On the contrary, I would argue, given the scale that we have got, given the track record that we have got as an industry, given the intense regulation and the public scrutiny that we have, an intensely monitored and intensely audited industry that we are, and the talent that we have developed, this talent should be leveraged for us to manage a lot more money of other institutions where I think it could be, I think some of those resources may be suboptimal. And that will give us economy of scale for us to invest a lot more in going to the next 100, 200, 500, 500,000, maybe in my lifetime, to all the villages where we get the money from.
Okay. So let's move on. Radhika, one big opportunity or one big challenge, I would say, in front of the industry, and this is also when we talk with various industry players, is talent. Okay, we've seen fund managers like Prashant Jain, Naren or Harsha, been there for like 2 decades or so. Today, the competition has also gone up. We don't see fund managers sticking around with organizations for so long. Do you really think that we'll see the next Prashant Jain or the next Kenneth or the next Naren? And, how are you going to nurture the talent? Because there are new fund houses coming up. Costs are going down. You have to pay fund manager salaries. Of course, salaries are good, but what's the next 5 years, 10 years looking for from talent management?
Yeah, so before I answer that, Keza, I'm glad that you said mutual funds have a lot of competition, but for once you didn't include crypto. So one asset class, at least we put a nice lid on for the time being. Look, I think Navneet and to an extent Nilesh started their journey much earlier as brands, and they're backed by large financial institutions. But before I come to the talent question, what I would say is that the journey of building a profitable asset management company, if you are starting late, is not an easy one, and I don't want to mince words around that. In the last 5 years, I've seen our own trajectory go from about 40 crores of loss making to 30 crores profit making. But, it is a difficult one. Costs of compliance are going up, costs of talent are going up, and margins are going down. And yet, it can still be done. As far as talent is concerned, firstly, I think due respect to everyone and all the names that you've mentioned, but I think one thing that we have to realize, and this is something we are cognizant of when we build a business, is that talent is mobile. It will move to opportunities within mutual funds. It will move to opportunities outside in other asset management spaces like PMS and AIF, and it may exit the industry to go to fintech or RTA or anything. So I think we have to realize that talent is mobile, and I would argue that younger talent is even more impatient and more mobile, and all of us are seeing that. We live in the time of the Great Resignation. So I think one lesson for us as a fund house is that while we respect investment talent, and that's the core of what we are, we build ourselves in a very process-driven way. we just had a change of equity CIO last year, and it is a major change for any fund house. But we've managed to go through the change without any impact on performance or business. And I think that will be the kind of reality. So you ask the questions about succession planning, you ask the questions about process, and you build for the fact that talent will migrate. I think we also have to find ways, we've been very fortunate in the last 5 years, we've gone from 40 to 300 people, so it's a new team. Despite turmoil in the parent in 1819, we haven't lost people. So I think talent is never just about compensation. Talent is about the opportunities you give them. Talent is about the growth you give them. So that, most mutual fund managers are very excited to be mutual fund managers. The opportunity to manage hard-earned public money and build a public track record is something that you can't.
But the alpha generation is becoming difficult and difficult, more so especially in the large cap space. I mean, you yourself had told me that you had reduced your expense ratios for your large cap fund because, it's difficult to justify when the alpha is so small. And, when you're getting, opportunities elsewhere now in the industry, small cases are there, PMS is there. Now, so you've had instances of fund managers leaving AMCs and joining, starting their own PMSs. Where does that leave the mutual funds industry from a talent perspective?
I think with due respect to, and, many of us run PMS, AIF, small case and all the platforms, the opportunity to manage public money on a platform like mutual funds, where in a regulated format, you've built a public track record. And many of the names, by the way, you've said, Prashant Jain, etc., are household names because they are known by common people. That's something you can't buy in money. I doubt many small case managers have that kind of legacy. So I don't think you can take away from the opportunity. And this is what people tell us in interviews. For every person who's going to PMS and AIF, there are managers coming from insurance or PMS and AIF who want to have a career in the mutual fund industry. As far as alpha is concerned, I think Nilesh Bhai put it well. There will be good managers, there will be managers who outperform benchmarks, there will be ones who don't. Those who add value to their organization and customers and to the benchmark will get paid well, and the others will not. There is no arbitrage in the market in that sense.
Okay.
Can I add something?
Yeah.
So the mutual fund industry's talent retention will depend upon a woman like Parul Shah, who's my wife, my better part, and also Navneet's wife. I get 100 rupees salary, 43 rupees taken away by government straight. So I'm left with 57 rupee. To secure my future, I give 10 rupee in NPS and 10 rupee in Provident Fund. Effectively, 37 rupee comes to my hand, of which SEBI takes away 20 rupee by skin in the game circular. And I give 17 rupee to Parul Shah. As long as she manages my house in 17 rupee, I can work in Kotak Mutual Fund.
Does she invest her money in Kotak Mutual Fund or other schemes?
The 17 rupees kaizad which is left, I am sure women have the power to save out of that.
That I agree.
Every woman is blessed to run the house with whatever money she will get. The second thing, sir, that will be for my kids, not for my wife. The second thing, and which is more critical, is the space given to us to go out and build mutual fund industry. There are days when I haven't attended PTA meeting of my kids because I was in building mutual fund industry. We could all do it because our better part was willing to back us up. As Radhika mentioned, all of us, if we work individually, will earn more than what our mutual funds are giving. We are working in this because it gives us respect. In my engagement period, ours was an arranged marriage. My wife was a professor. Wherever she used to go, she'll get respect from her students. I was always wondering कि एक दिन ऐसा आएगा कि अपने को भी respect मिले. It is thanks to mutual fund industry that we are getting that respect. This is the industry where I can make money, I can get respect. So as long as we have women like Parul Shah, I'm sure there will be talent in mutual fund industry. The day we miss that, I don't know what will happen.
Nilesh, speaking of women, you know, I'm still supposed to be on maternity leave because the government rule is 6 months and my son is 5 months. I started working after 6 weeks because I love this industry and that's the respect it gives you.
Okay, let's move on. Neil, you've been quiet for quite some time, so let's bring you in now. Neil, you know, your fund house, when you all had launched, I think, what, 9 years now, Parag Parikh?
9.5.
9.5 years. You know, it has been an inspiration to a lot of small-sized and new fund houses because your fund house, I remember it was launched on, you know, the basis of certain principles, certain ideals that, you know, you will launch only one fund, you know, one fund. That one fund will do everything. And you know, you will engage with distributors in a limited way. You will keep your costs down, etc. You know, those ideals your fund house was launched, and most of that you have retained it over a long period of time. So you are one of those niche fund houses, and there was a space and time for niche fund houses even in the Indian mutual funds industry all this while. I'm not saying that there is no space going forward, but that is what I wanted to ask you. That, you know, when you are pinning all your hopes on just one fund, and when things don't work the way you want to, like for example in this 1 year has been tough because, you know, your 26% you have been investing in international equities, so that's basically been affected because of the tech crash, and also because, you know, the RBI and SEBI has not yet revised the limits for international investing. So that approach, you know, the niche approach, you know, one fund, I will do everything in just one, I will not launch a supermarket. Is that principle still valid when the industry goes from 40 trillion to 100 trillion? I mean, how much of a mind share or market share would you still retain?
Yeah, so we were asked the same question at 10 lakh crore when we launched, and we had 40 lakh crore, and I think we've done reasonably okay in this journey. So I think if there's conviction in what you're doing, if you are adding value to the investor, if you're building trust, and you're investing your own money in the schemes you are going to launch, you know, and one of the things we've said is that this is something that there's a fiduciary responsibility to it. So we do what's good in the investor's interest. So we will launch funds only if there's some simplification or differentiation we can do. If we can add value to the end investor, and if we are excited to put our own money in this fund. If I am not excited to put my own or my family's money, then I cannot go to someone else to say that put money in my fund. So as long as these three things are there, these three criteria are sorted, then we will launch funds. It's not like we will not launch funds, but it has to make sense to us, and it has to make sense to our investors for doing that. And I think you can be valuable, and mind you, we were profitable from year one, you know. So at 150 crore AUM, we were profitable. Today at 30,000 crores, we are way more profitable. So profitability has never been that much of an issue. I think if you run a lean organization, I mean, if you don't overspend on things that you're not supposed to overspend on, then you can be profitable and you can run this with very few schemes. So I don't think that's a challenge. I think 40 to 100 also, I think we will do what we are doing because I think we've got conviction in what we are trying to do.
Can fund houses in these days survive with just one or two schemes? You know, you have to also nurture talent, and you're pinning all your hopes on one scheme, you know, on one set of market conditions.
Yeah, so look, I think you cannot look at performance over a year or 6 months, and unfortunately that's what happens in the market, right? Everyone looks at past performance of 6 months, 1 year, but I think one of the challenges is to make sure that the investor has the proper mindset, you know. The expectations are managed well, you know. So you cannot, if we are talking right now about 6 months and 1 year you didn't do well, but we're talking about, and when we all talk about equity as a 5-year, 7-year product, so I think we should look at it through a 5-year, 7-year period. So I think a lot more education needs to be done, a lot more good communication needs to be done. And yeah, I think you can be profitable with a few schemes. I mean, yeah, if those schemes are 30,000 crores, then sure, you can be profitable.
Okay. Shrikant, hi. We're glad that you can join the panel. Shrikant has had a very busy day today because KF Fintech has just headed for its IPO. So he was busy with all the road shows. But thank you so much for making it for our panel. Shrikant, one aspect where an R&T such as yourself comes in is customer service, the kind of experience that you all give to investors after investors enter mutual funds. Now, performance and alpha generation is a headache that is shared by the rest of your panelists. But customer service, because when you are facing the customer directly, you're handling their records. You know, one thing I can't oversee is that, you know, where industry has expanded, number of players have gone up, number of investors have gone up. The number of R&Ts have basically gone down. Earlier, you had a few small competitors. I suppose even Templeton and UTI had their internal R&Ts, but even that is also now gone. So it's only the two of you all. It's a duopoly. You know, investors are going up. I think there are, what, I think 4 crore investors in mutual funds today. So realistically, two things I wanted to ask you. How many customers can a single RTA can realistically manage? And number two, do you think that the industry has now come at a stage where we need more RTAs for better customer experience?
Thanks, Kezad. I'll go back to probably Neil's answer in terms of, I guess, similar question could have been asked when we were 10 lakh crore or 5 lakh crore. I think, you know, we, as registrars, seem to be able to manage the workload reasonably well. I think, you know, not too distant past, this country has had close to 10 registrars, several of them multinationals, including Morgan Stanley, JP Morgan, Citi, Deutsche, Franklin Templeton, so on and so forth. I think the consolidation has happened largely on the back of, you know, being able to, you know, entity being able to provide superlative solutions at a cost profile which makes sense for the market. I've heard about alpha compression, and hence, you know, every penny counts. So does the registrar's cost at that point in time. In terms of what is that we are able to bring to the table is that an elevated levels of services baking into account a significant amount of regulation that has come into the play over the last 3 to 4 years, yet delivering at scale in terms of the number of investors. Right? I mean, today we manage close to, so as a registrar, we are not just in mutual funds, we're also in the secondary markets, right? Just so that you know, our total scale of operations, including that of secondary market, is close to 22 crore folios on a unique investor base of close to 6 crores. So what you're really talking about is, you know, as a single entity and not even including the larger, RTA camps here, we ourselves are today able to manage 20 plus crore folios spread across 6 crore investors. So you already have a use case of an entity which is able to do it, which is pretty much the entire combined mutual fund space put together, and probably 50% more of that. Do we need more registrars? I think it's always good to have more players. I think innovation is something that always gets the better of it, when you have more players to add.
And I'm also talking from the point of view of cost reduction also, because the cost that you all charge to the AMCs, some of them privately say that, the costs are a little high for every little value add that you give to the AMCs. Now, when you are headed for an IPO, you are supposed to be thinking about your shareholders' interest, your top line and bottom line also matters. So I'm really wondering, is it conflicting with, the relation that you will have with the industry going forward? Because your priorities now would need a little slight altering, no?
Okay, now several of the participants, delegates, and the co-panelists are my clients, so it's a tricky question to be answered. But let me put it this way, right, Kezad? I come from IT industry. I'm not from asset management background. You're all, for me, people whom I look up to and respect and try to learn as much as I could. What I've seen is our commercial model, if you read it, it's largely certain basis points on the assets under management, which effectively translates and mirrors the growth of my client. So my client grows, I grow. My client does not grow, I do not grow. So a time like COVID, for example, when the markets fell 50%, right? Clearly our revenues did, but my cost does not come down, right? So, we partner the growth of the client. I think it always happens that when a particular asset management company grows very fast, given that my basis points continues to remain, similar, there is a tendency to feel that, oh, well, I'm paying a lot. But the same does not count into account when the markets are subdued and not growing at all, right? And obviously we bear the brunt because our costs continue to expand. But let's put some facts into perspective here, right? Against the total expense ratio, the blended yield of a registrar is about 3 basis points today, right? That's the total blended yield across all asset classes across the industry at this point in time between both the registrars put together. I don't know if it is that material for the entire gamut of solutions and services we provide. a large asset management company, will require at least 500 to 600, maybe even 1,000 people to work, despite significant investments into technology. Technology today subsumes almost 40% of our costs, right? I mean, elevated service levels, things that used to take days, today gets done in seconds. So I'd like to believe that that much amount of wiggle room should be provided to a partner such as us, because it is through that mode that significant amount of innovation could be brought into the table and not just provide, bare bricks of solutions and services.
Okay, I'll let you go this time. So, anyways, thank you so much.
Can I make a tiny point?
Yes, please.
I'm one of Shrikant's clients, so I'm going to upset him ahead of his IPO, but I'll take the liberty to do that. There is a lot of focus on the costs of asset management companies and us, and active and passive, and how much alpha and fees. I run a debt passive business. We are, fairly large in that business, let me say that. And my Nilesh Bhai just talked about his salary and where it goes. Let me tell you where my expense ratio goes. I charge an expense ratio of 15 basis points in the direct plan. 1 point I give to Amphi for investor education. And 7 basis points I give to my RTAs, NSDL, custodians, index providers. That leaves me with, I think, 6 or 7 less basis points. I actually earn as an asset management company less than all the service providers. So I think that there needs to be, in fact, I keep joking that if I were to ever quit the industry, the business I would do is form a Digi RTA. So I really think more competition in this space is welcome, and a lot more focus. If you're going to focus on a passive industry, a lot more focus needs to come on the cost of operations for AMCs.
Point taken, point taken. Okay, so folks, we've completely run out of time because Nilesh and Navneet and also Kalpan from our next panel, they have a flight to catch. So thank you very much for a lively panel discussion. And I'm sorry that I can't take any questions, but we'll try and take questions in the next panel. But thank you very much. Okay, so we'll move on to the next panel now, which is the advisors panel. And here we are talking about the rise of financial influencers. Now, in the last couple of years, we've spent so much of time thanks to work from home and all. People have spent a lot of time on the internet in front of the computers, laptops, and social media also. So there's no denying the fact that social media influencers is one breed that has really benefited in the last 2 years. Now, we know that social media influencers talk about everything from food, fashion, travel, lifestyle, and even to boring topics like mutual funds and personal finance. The problem is that, there is delayed gratification when you advise on a financial instrument because, whether you make money or not will be evident only 5 years later. And if you lose money based on an advice which has been given on the internet by a financial influencer, you don't know after 5 years what's going to happen to your money, and if you have incurred a loss, who to catch. So the question we're asking today is, is there a line that one can draw what influencers say or they cannot say? Is there a way there that we can, retain the communication skill that financial influencers bring on the table, but at the same time try and control some kind of an advice that they give? That's what we are going to be discussing in this panel discussion. And may I please welcome my 3 panelists. We have Pranjal Kamra, who himself is a financial influencer, but he owns a firm called Finology, which is a SEBI registered RIA. We have Kalpen Parekh, who is the CEO of DSP Mutual Fund, and Harsh Rungta, who is a registered investment advisor, a SEBI registered investment advisor. Welcome, Harsh, Kalpen, and Pranjal.
It's on me, so I'm very nervous.
Which is why I've kept you separately and I've kept them separately, so that there's no throat slinging. Okay, so Pranjal, we'll get to the specifics as we go along. Just to set the context of the panel, you're a pretty popular financial influencer. There are many other financial influencers out there who are as popular. I was checking your YouTube channel. You have about 4.7 or 4.8 million subscribers. Others have also been as prominent or even more prominent also. There's obviously an audience for financial influencers out there. Whether it's good or bad, we'll discuss it as the event goes. But, why are so many people queuing outside your door to listen to what you have to say? I mean, how differently are you doing things that, let's say, an industry which is 36-year-old industry, or even advisors and distributors who have been there, that they haven't been able to do? Can you put that into context for us?
If I am to be brutally honest, there are two ways about it. One is almost all finfluencers, as now this category is called, are unregulated. So I'm one of the very rare regulated ones. And when you're unregulated, you're not playing by the same rules. You're not bound by the same disclosure requirements, the same rules that registered entities have to go through. And that gives you a lot of leeway to play around. So that's one. And second is, a lot of content that's consumed in the name of finance is actually creators providing entertainment. Saying things like, instead of buying a Royal Enfield bike, if you would have invested in the stock. And what would I do? Would I walk for the next 20 years of my life? Advices like these. If you would have invested 40 years ago in a particular stock, your amount will be this, and things like that. So if you sell bite-sized packet of entertainment disguised as finance, people are hooked to it. And you're able to do it because others can't. The reputed players can't. Just to give you an example, why does all crypto apps are from new players and no players like HDFC or Kotak brings in crypto app? Because they don't want to be on the wrong side of the regulation. Whereas someone who has nothing to lose takes that risk to be on the wrong side of the regulation. And which is where I think, this discussion of SEBI coming up with a guideline to ensure regulation for influencers is important because, influencers sell all kinds of things. We sell technology, mobile reviews, beauty product reviews. But say if I'm a tech influencer and I recommend someone to buy a wrong phone out of, being compensated, and a customer buys the wrong mobile phone, probably he'll lose 10, 15,000 or 20,000. But if I, under the influence of money, sell someone a wrong insurance policy, his family's life would be in ruins. So the onus on finfluencers is much more than any other influencer. And which is why I think this is a great step. We should be regulated.
Okay, fair enough. And we'll get into regulations a little later. But Harsh, let me bring you in. You are a SEBI registered RIA. I mean, if anyone over here knows the intensity of advisor regulations by SEBI, it's you. Just to play the devil's advocate, I know that you guys are heavily regulated, but because of the strict regulations, because of the compliance, you have to have a compliance officer, you have to maintain telephone records, you have to maintain so many things, because of which your costs, goes up. As a result of which, registered investment advisors don't really cater to the retail investors. Okay, a 5,000 or a 10,000 or a 1,000 SIP customer walking into your office won't make monetary sense for you. And your RIAs have traditionally catered mostly to rich investors, HNI investors. So if, I know that your community is up in arms against financial influencers, but just to play the devil's advocate, if the influencers are talking to the retail population, why is it so, in your assessment, bad when RIAs themselves are not really, talking or entertaining retail investors, a very, very bottom of the pyramid retail investors?
So first of all, I have not really, as in profession, I haven't really heard, or myself personally, we haven't said that fin influencers are bad. I think they've bought, as your panel title says, they've bought democratization on advice. So it's good. They've bought finance to the masses, right? It is very difficult to catch the attention of a 20-year-old or a 24-year-old who's just started earning to now look at financial assets. If that has been achieved, how it has been achieved is something else. But if that has been achieved, there are lessons that I think we ought to learn. And just let me give you a parallel example, simple. I'm very much into health and wellness, longevity, health lifespans and things like that. Now, am I qualified to talk about it? I don't have a medical degree. I do a fair amount of research. I do a lot of self-experimentation on that. So obviously, my family is fully involved. I talk to them. When I talk to them, I'm not telling them, be careful. They know that I'm not a doctor. Now, I meet you. Okay, you're a good friend. I want you to benefit from the things that I have learned. But when I advise you, okay, I will tell you, see, this is what I have learned. I've self-experimented. Okay, but before you start anything, please talk to your doctor. Okay. Now, I have a little bit of, I don't have 5 million followers that Pranjal has. And Pranjal, by the way, should have been sitting on this side because both of us are RIAs. But basically, if I have some following, right, and if I am telling them something, I think there is and it is something as important as health. Money comes a little down, but not much down, right? If it is something that can affect their health adversely, if there is a possibility, I think it is incumbent upon us, upon me, to be able to tell people कि भाई मैं qualified नहीं हूँ इसके लिए, this is what I have learned, and look at this could be beneficial to you. That's where regulations help. Regulations bring credibility.
So one thing, obviously, what I'm picking up from you are saying is the distinction between what is investor education and what is financial advice. Kalpin, the line is...
Just one more point.
Sure.
One more point. I think the responsibility, if I'm getting compensated, if suppose I'm saying I take certain supplements, and now I go to the supplement guy and say, hey, you know what? A lot of people can be influenced by what I say. Do you want to pay me something if I, take your name? And there are supplement guys who are incidentally willing to pay, right? If I'm doing that, and if I don't disclose that fact, I think that is bordering on, it's not bordering, I think that's plain wrong. Because conflict of interest is a very, very powerful thing, which to some extent the impact can be mitigated through disclosure that makes sense, not disclosure that is added at the bottom star and subject to terms and
endorsements, and also when you're giving advice, when you're not, let's say, a trained professional in that field. So Kalpin, you've been an effective communicator yourself I can say that in the Indian mutual funds industry, you could call yourself an influencer, but of course you are a mutual fund CEO, you can't, cross the line. But you have been using the platform to communicate simple concepts like SIPs. You have been having conversations with your son to explain international investing, SIPs, and etc. But my question is that, giving investor education is one thing, giving financial advice is another. And the line is drawn in sand. We've seen many influencers give videos on cryptocurrencies, for instance, in the last 1 year. And nowhere in the video do they say that invest in cryptocurrency, but they make it so glamorous, they make it so charming that eventually people get swayed. Oh, it's the next big technology, let's invest. So where do you draw the line? And what is financial advice? And because once you define that, I suppose then regulations can also pinpoint saying that this advice maybe it did not work.
So Kaizad, I think we should be realistic about what can be done and what's possible, and more so in the world of investing, which is one multi-dimensional and hundreds of variables, and where the outcomes are also never certain, they are probabilistic. You may think X and Y may happen. Drawing that line is a challenge, and creating boundaries through just regulation alone is not easy. So completely, welcome the point that Pranjal started off by saying that some broad regulations to harmonize the rules of transparency, skin in the game. RIAs or fund managers have, skin in the game. So likewise, what role or what skin in the game can anyone else who's giving advice. All of that needs to be harmonized, and I think the recent paper by SEBI, indicating these direction is welcome. But the bigger point I'm trying to say is that the whole approach here should be what is right to do should be the starting point, and anyone who is venturing in the field of giving advice, either because of his job today, let's say it's my vested interest that I give advice which can draw investors towards my fund house or my industry. I think the starting point starts from your personal value system. That if I can, recommend my sister or my brother or my mother or my father to invest their money in this product, I'm happy to give that advice to anyone and everyone, with all the disclaimers that I can still be wrong. But if I'm never going to put my own money and I'm still advising, then that is where the risk starts coming in. The second thing is, I also feel that as a consumer of this advice, as a consumer of listening to all the advisors, whether you call them influencers or XYZ, the consumer also needs to know that there's nothing finite in this world. And I'll give you two examples. 2 years back, I was extremely fascinated by Kathy Woods of ARC. And the way she was running her business model, the way they were putting out their analyst reports and everything publicly. And I should tell my team also, कि कुछ सीखना चाहिए. And how did I know about her? Only through social media. So social media has democratized access, and sitting here in Mumbai, I could think about someone like that. And there was a lot of influence. Maybe her intention was right or wrong, I'm not debating that. 1 year later, I bumped into accidentally a guy called Christopher Bloomstein, who actually, point by point highlighted why that business model is completely flawed and why that type of investing will lead to accidents. So as a consumer, I had access to both and opposite sides of the coin, but somewhere, then you apply your reason, your sort of understanding to take those decisions. If consumers want to get carried away with, nice music and dance and then, put their hard-earned money to risk, I don't think you can blame others. It's very important that today my son wants to, he goes for his engineering classes. He doesn't go to an influencer YouTube program to learn engineering course. He goes to a bloody class and he spends 9 hours there every day to learn and study. I think that balance is very important, where we as investors also, recognize what is right for our hard-earned money. We work so hard to earn our money, but we virtually don't do any hard work to know where do we seek advice from. So partly the balance will come when investors give up on their greed on one hand, and of course the responsibility from the side of advisors or whoever is giving that advice is far more, that we cannot give that advice which we don't believe in. And the next point that I always keep to myself, I tell this to myself, I remind this to myself, I tell this to my team, is that anything in investing, for that extra return that we have earned will come only because of the extra risk we have taken. And there are times that risk will not work. There are times that risk will backfire. And what will happen when that happens, there can be temporary loss. There can be, lesser returns. Talk about risk as much. We always say there are two sides of the coin. But generally, I've seen that we all get swayed by the positive side of the dimension. See, today, if you keep a topic of $100 trillion of the fund industry, there'll be more people to listen to it. But if you say that, for the next 2-3 years, we'll remain at 40 lakh crores, maybe no one will want to listen to it. So the bias towards optimism is so embedded in anything related to money that advisors or influencers or finfluencers, whatever you call, or investors themselves, everyone is swayed by extra optimism. And that is where that balance is required. The world is not one-sided. The world is not always about positive returns. There is the other side, which is risk. The rule that I've kept for myself is always show risk first. If you show risk first, most things will fall in place. Now, if I tell an investor, so I give a real life example. There is a fund, and many fund houses have these type of products which have completed 25 years. So it's very easy for me to come up with an ad that in these 25 years, the fund has gone up by 80 times. It will have great number of likes. But if I say that to get that 80 times, you had 4 phases of zero returns for 3 to 4 years. You had 2 phases of 50% loss of capital temporarily.
Or a simple thing like how many investors actually stayed for 20
So in the same fund which has gone up by 20 times, 80 times, there are 26 investors who have stayed invested in a journey of 25 years. So for 25 years of history, and only 26 investors have stayed through. So the point I'm making is when you talk of risk, it is less fashionable. It is not entertainment, like he said. Talking about risk is not entertainment, but we are not in the business business of entertainment. We are not Vidya Balans who will say that, this movie will sell if there is entertainment, entertainment, entertainment. Last point, yet I would love to learn how to make risk-based communication entertaining. I would love to learn how to, talk the language of the consumer. One area where influencers, we need to learn from them is how can they talk the language of the consumer, what they talk every day. When I talk of Sharpe ratio and beta and, what is Fed going to do, my sister, brother, mother, wife, son will not understand anything. So if we are able to, change the narrative from either or to and take the best of both, I think there is a huge opportunity to democratize advice without diluting advice. Currently, both are happening. The topic of the session was, is it democratizing or diluting? I think both are happening. It is getting democratized, but anything in scale also dilutes.
Okay. Harsh, what about registered investment advisors? I mean, you all have, amassed customers over a long period of time. And, you were seeing how the communication is now changing from when financial influencers have come into the market and the way they communicate. Has that had any repercussions, or in the sense that influence on the way you all communicate to your customers? Because you will, after all, support generations of generations. Like, I mean, somebody in their 50s and 60s, and, eventually, when their children come into the workforce, you and your firm will now have to speak to them as well. So has that led any impact or change in the way you communicate with your customers?
Obviously, I think, so first of all, the profession itself is pretty young. The regulations themselves came out in 2013. You could say that it got formalized that. Advisors have always been around. It got formalized and rules came into play in 2013.
CFPs were there, Certified Financial Planners, fee-based planners.
Little bit before that, right? So my point is, has it changed? Obviously it's changed. Hasn't it changed in every sphere? Okay. Again, I would just like to take the example of medicine and what it has changed for me, and then I'll quickly come to how it has changed. What it has done now, when anything happens, and I've seen both the eras, right? So before that, the doctor would give me a medicine and, I would take it and, would typically get better. Now, I ask the doctor various questions. Okay, why are you giving this to me? What are the side effects? Are there anything else? Is there an alternative that I can do? Okay, so what has that done? Now the doctor expects these questions. I think he is a much better professional because of that, right? So coming to the, finance to us, what it has made us do is that we have to be on our toes, right? When a client, we know clients are going to ask questions, we better have whatever answers we want to have, right? That, I think, is a very, very positive development in terms of making the profession more interactive. One of the things that at least I practice personally is that, the crypto craze, and there would be clients, and as you mentioned, a lot of our clients happen to have a lot of money, right? So when they come up with this kind of a thing, one of the things that we have done is that, can you make this part of your discretionary fund? Okay? This discretionary fund doesn't go into any of your planning. We will probably not even take it into asset allocation, except to take a certain percentage for the discretionary allocation. You want us to account for it, we'll account, otherwise we'll not account. Very clearly, we'll not charge a fee on it, so that in the future, I can remind you that, this was not something I had recommended, right? What that has done, and there will be comebacks, right? There will be good advice that they might get. Those advice might work for a time. On cryptos, when I told clients I don't know, there would be a couple of clients who says, how can you be an advisor and not know about crypto? I said, I don't know. Okay, I can't be expected to know about everything. So coming back, it's a huge opportunity in that sense, in the sense that some of the untried things, which, unregulated influencers have the ability to propagate, probably will end badly, okay? And some of that blowback obviously will come back to professionals like us. That is the opportunity. The threat, the financialization that we have seen, the, huge thrust in financialization that we have seen, in that blowback, not all of them are going to come back and remain in the financialized system. Some of them are saying, ye bahut naya cheez dekh liya, let's go back to the good old gold and land. And I think that is a big damage generally to the society, to the country, to the world actually. So I think that would be a real pity.
Pranjal, you and Kalpin both spoke about the element of entertainment that's very much prevalent in the influencer space. But how do you retain the sanctity of a financial advice? I mean, where does entertainment stop and where does genuine advice or genuine gyan begin?
See, I'll answer this through the evolution of influencers, and I think our evolution has to go with all the malpractices that were to an extent happening earlier and were not out in the public. So for example, when I used to say that direct plans are much cheaper, don't mix insurance and investment. I thought traditional, because advisors also came 7-8 years ago. So before that, insurance was commission backed. So people started trusting me and influencers like me because we were telling them a side of financial product that no one was telling. So when I say them auto sweep, you can get more out of your savings account, or direct plans in mutual funds. That is how we built trust, which in my mind also happened because the traditional participants were not telling the people enough. So that is how we trust built. And we were honest back then as a group, because we were not being incentivized. Back then, 4 years ago, no one was paying for influencers.
That's the problem. No? Because today you've become so famous
that we are corrupt. We are corrupt because what has happened is VC money has flowed in the fintech sector. And when that money flows into the fintechs, it eventually comes to us. And that amount is huge. Just to give you an example, I'm very upfront about this. In the last 2 years, 2020, 2021, I would have left at least 1 crore rupees on the table by not promoting cryptos. That to someone who doesn't have alternate sources of cash flows and it's just starting is huge. I'll tell you an example. This is really funny. One time I've taken money for cryptos because that brand was so desperate to have me, and I'm against cryptos. Finally, they offered me, okay, you come to our platform and you criticize cryptos. I said, if you're giving me money to criticize cryptos, sure, I'm coming to you. So there's one video of me talking to a founder of a crypto app where I've criticized, and he was ready to pay me money for that. That was the amount of desperation with which money was coming in. And it's really sad in the sense that in my mind, I was trying to educate public about the wrongdoings in the financial industry. And right now, us as a group are the widest source of misinformation. So in fact, we have become the evil that we started out to defeat in a way. And I think as long as financial incentives are this huge, which is where I believe that disclosures, so SEBI coming up with the consultation paper, I think there's one key difference is there's no KYC in social media. All other financial entities can do KYC. Therefore, they are in a contractual obligation with their customer. They know who their customer is. And they can choose to accept or refuse a customer. We can't do that. So therefore, I think any strict regulation coming up is liable to be struck down based on violation of free speech. So as hardly as I want a regulation, I think in order to be, and there's also one point, there's no entry barrier. So whom do you regulate?
And also platforms, because today the emergence of like after Elon Musk took Twitter, there were so many other names being circulated.
And there's no entry barrier. I mean, even to become an mutual fund distributor, there's certain amount of process. So you know whom to regulate, those who have completed that formality. But social media, how do you create that entry barrier? You need an entry barrier to be able to regulate. So I think either self-regulation, because if tomorrow.
What about endorsements?
So yeah, that's my first point. I think the worst financial advice is the one which include product promotions. Incentives are huge. If influencer knows he or she is doing the wrong thing, but I think everyone has the price probably. That happens. So I think one clear way to start off the regulation is to make sure to have a maybe standard operating procedure that if it's incentivized, how do you disclose it? Because right now the platforms, so Instagram has a paid partnership label YouTube has a this video has paid content label, but that's just for the sake of it. That's not enough. Everyone misses it. It's meant to miss. So I think how to disclose, it needs to be very, very clear. And if it, and you know, it needs to be absolutely upfront that these are the 3 steps, 4 steps that you need to follow. No vagueness around it, and everyone has to follow it. That needs to be the first.
Okay. Kalpan, last question. We are really running out of time. But speaking of paid endorsements, giving money to financial influencers to say what you want them to say, some mutual funds have been engaging with financial influencers. What is your opinion on that? I mean, do you engage? What's your opinion on the other fund?
So, I look at this as any advertisement.
How do you regulate that?
Sure. So my point is that when I give an ad in a newspaper, it is paid endorsement. When I give an ad on digital platforms, I'm still paying for an advertisement. Likewise, if I were to do something with a influencer, it is paid. I think the starting point is what is the intent of doing it, and what are the guidelines you are giving. So even like we have a very strong guideline internally in terms of we have a checklist. We have a score that which influencer do we want to partner with, if at all, and what is the message. The messaging is controlled by us, and as long as we are very clear. So I'll give you an example. When around a year back we launched a global innovation fund, our messaging was very clear, only SIPs. Because we were seeing that space, while it has very good long-term potential, but has also run up a lot over the last decade. And of course, we didn't know when is the correction going to start. So the only messaging was only via SIP. So there are strong guidelines that we keep in mind. And I think it's all about each entity having their own value system to say what do we want to communicate, with what responsibility do we want to communicate, what is our own assessment of the risk in what we are talking. Because like I said, with advice, the challenge of advice in investing, the unique thing is it is right as well as wrong. It is just at different points in time. So crypto was right 3 years back, because when a lot of people would say, "Itna paisa ban gaya aur tumko malum hi nahi hai." So it was right. Crypto is wrong today. So any advice is right as well as wrong, just the time horizons are different. So the lens to judge advice or outcomes in investing are always very, very superfluous, and which is why intent is very important.
Engagement with financial influencers by mutual funds, you're saying it's permissible, but you need to be a little bit more...
more responsible towards it, more responsible, what type of messaging. And like I said, what we need to do is, get the best out of both. Let responsibility come with experience and history, and let the art of talking to consumers in their language in an interesting manner. Not necessarily, it could be even entertaining, but if you can deliver entertainment with responsibility, that is the best of both worlds. So we cannot be binary. We can't be only responsible and boring, then the message will not reach people. We cannot be only entertaining but oversimplify so much that you have not highlighted the things that can go wrong. So, like I always say in every debate where I've been invited, I always say that, we are here to debate, but it doesn't have to be or, it can be and. We can take the best of everything, we can eliminate the worst of everything, and try to create a better outcome.
Okay, thank you, Kalpan. And with this, we come to an end to this panel. A round of applause for all 3 of our panelists. And thank you so much for patiently listening. Thank you.
Thanks, Kaizad. Very insightful and interesting conversation. All right, so loans. I'm sure you've mostly come across borrowing loans against land, gold, or perhaps a house. But if you've put your money in a mutual fund investment, can you take a loan against that? Well, that's what we're here to answer. What are the advantages and challenges when it comes to taking out a loan against securities? And to answer all those questions and more, joining me on stage right now is Krishna Kanaya, CEO, Mirae Asset Financial Services. So before anything else, I'd like to understand about the NBFC business that has been set up by Mirae Asset. What is on offer there?
See, till about 3-4 years back, people used to look at Mirae Asset and think about only one fund, which is Emerging Blue Chip Fund. Over a period now, the mutual fund business has grown. And now we are recognized as a full-fledged mutual fund house with multiple schemes across the asset class, both on active and passive sides. Very few people know we have also diversified into multiple businesses within financial services. The latest one is NBFC. So Mirae Asset Financial Services India Private Limited is a registered NBFC. Recently we have launched loan against mutual funds. The loan is available against mutual fund schemes of all the fund houses serviced by both Karvi and CAMS. The loan is available on mobile app. And just 2 weeks back, we have also launched loan against shares, which is available to demat account holders with NSDL.
So if you could really quickly summarize to us, what is loan against mutual funds and how does it benefit investors?
See, as the name suggests, one can avail a loan by giving mutual fund units as a collateral. The loan that we provide is in the form of a OD, overdraft facility. So what basically you get is once the loan is processed, you get a limit based on the collateral that you provide. Within that limit, you can withdraw or repay the amount, any amount that you want, any time, without any limitations. So there is no EMI payment. You can withdraw the amount within the limit anytime as you want, and you pay interest only on the amount utilized and for the period that you utilize it for. When we talk about how it benefits the investors, we are talking about 100 trillion mutual fund industry, 13,000 crores SIP book, monthly SIP book. When we look at these numbers, I think one thing is pretty sure that the investors have learned to invest for long term and for long term goals. But sometimes they are faced with some short term money requirement. That could be house renovation or a short trip somewhere, something, right? Various needs. Because mutual funds are liquid and unlike gold or property, they tend to go and redeem their long term mutual funds. The product comes into picture here, the loan against mutual fund. It provides you liquidity for short term without compromising with your long term goals. And this is where it adds value to the clients.
And is that why it's perhaps a better collateral than any other asset, you'd say?
So if we compare mutual funds or shares as a collateral, there are a couple of more collaterals that comes to my mind. One is gold, second is property. I would say mutual funds are better collateral in two terms. One is because it's financial asset and liquid asset, the interest rates charged on the loan is much lower as compared to loan against gold or loan against property. Second, due to digital lien marking, the complete process can be completed within 10-15 minutes. And so the processing time for the loan is much, much lower than the loan against gold or the loan against property.
But how long does it take to disburse the amount? What are the interest rates like? And how much of a collateral value do you typically need?
So as I said, Mirae Asset provides loan on our mobile app. The complete journey you can complete in 15 minutes, less than 15 minutes.
Including disbursal?
Everything. So broadly there are 4 steps. One is KYC, second is lien marking, bank mandate, and then loan agreement signing. The complete process is automated, so there is no back-end approval required. It's an automated process. Within 10-15 minutes, you can get the approval, limit is set, and then you can withdraw. If the withdrawal amount is below 2 lakhs rupees, it will take maybe 10-15 minutes, that is the NEFT time. If it is more than 2 lakhs, it will come instantly in your bank account.
Just one last question. What is the role here for MFDs or mutual fund advisors? What is there for them to gain here?
See, mutual fund advisors and distributors, I think, are the backbone for the mutual fund industry. They have done tremendous work that we have reached to 40 trillion AUM. They face with this challenge, it's a challenging job to first onboard a client, get a check from them, and make them understand to invest for a long term. When they face with this untimely, redemption, it not only hampers the client's goal, but also has a serious impact on the commission income that these advisors or the mutual fund distributors have. So by recommending this product, loan against mutual fund, it ensures that their income remains intact. At the same time, they help the client achieve or take care of their short-term money requirement without compromising with their goals. I think we have spoken about mutual fund Sahi Hai. With mutual fund Sahi Hai, people have understood how to invest in mutual fund, the importance of investing in mutual fund, not keeping money idle. The next level of learning, I think, will come that don't keep your investment idle. Use it to create a short-term liquidity. So mutual fund Sahi Hai, don't redeem it, lean it.
Well, thank you so much for joining us. That's a very interesting thought and interesting way to put it. And thanks for walking us through all the nuances of how lending can be possible via mutual fund route. Thank you.
Thank you so much.
All right, thank you for clearing up all our doubts for our viewers and sharing such pertinent points. Next up, let's put our hands together for the moderator of our next panel, Sonal Mehrotra Kapoor, Editor Multimedia, Moneycontrol.
All right then. Hi and hello everybody. I know it's been a long afternoon, lots to soak in, lots been going on. And some of us have taken a little bit of a tea and coffee break outside. So we're going to wait for them to come back. And we'll have Sonu Sood join us very shortly. So we'll have lots of interesting things to ask him as well. Now I'm sure a lot of you are wondering, what is Sonu Sood doing, right, in a mutual fund summit? Like, what do you want an actor for? What will he speak? What's really going on? So that's exactly the question we're going to put to him. And while we wait for that, I'll just urge if everybody outside can also hear us, just to come back in, wrap up teas and coffees and come back in so we can just begin our next session. And while we wait for Sonu to sort of come in.
India's leading business and finance platform for over 2 decades. In fact, we at Moneycontrol have grown from strength to strength this year to become your trusted partner for financial news and opinion. And over the years, Moneycontrol has gone to amplify its reportage to serve its audiences even better. The analytical and AI-based tools give investors the edge to take quick and informed decisions when it comes to their money. The world outside is changing too fast and too often. We therefore have sharpened our global markets reportage. The platform provides a 360-degree insight on why and how you can bet on stocks and assets across the world and find pockets of safety at home. Audiences have given a resounding thumbs up to these initiatives, and the numbers do the talking. Unique visitors grew by 22% year over year. The Moneycontrol app is again the undisputed leader in its category, garnering over 6 million unique users. Moneycontrol Pro, India's fastest growing business and financial category subscription service, has been listed among the top 15 digital news subscription services internationally. Take control of your money. Experience Moneycontrol.
The Indian mutual fund industry is turning 36. From a recovery mode, it has moved on to become a $1 trillion INR opportunity. And the momentum is right to assess our vision for its future. Moneycontrol, Network 18's flagship digital platform for financial news, has always endeavored to bring the mutual fund industry closer to its consumers. With its wide reach and association with industry experts, it has also been a knowledge-sharing platform that breaks down the fundamentals of mutual funds, encouraging the common man to transform into a confident investor. Now, as we step into a new year, we are getting ready to read.
Please welcome on stage. Can we have a loud applause, please? So Sonu obviously needs no introduction. I'll say a few lines, fit bhi, right? Sonu has played several roles on camera, big and small, but the one role, several heroes, several villains, etc. But one role he's really been gotten to know for of late is the real-time hero that he played during COVID. The amount of people you've helped has been tremendous, of course, and something that you continue to do, which has been the beauty of it all. So firstly, congratulations, Sonu, for having done all of that. And matlab ye kaise chal raha hai pura hame bataiye. Right now, how exactly is that moving forward? We see actors, you know, in their photo shoots, and we see them in gyms. We see you kabhi in a train, we see you kabhi making dosa street side. Like, what's really happening here?
Yeah, first of all, thank you so much for having me, and it's really an honor to sit with all, I mean, who's and who's of this country. So thank you so much for spending this time. Yeah, like you said, you know, when I came to Mumbai, I finished my engineering from Nagpur. I'm from Punjab, a place in Punjab called Moga. And I thought that, you know, life is all about light, camera, action. But I think from last 2 years, I realized it's not about lights, it's not about camera, it's only about action. So I think I'm trying to play the role that I always wanted to do, being a part of. I always see at every platform that, you know, I thought being a part of a 100 crore film or a 500 crore film was something that I came for. But now I realize, you know, everything looks very small in front of a smile on an innocent face, you know, when they come with so much of hope, and you can do your bit and you can change your life. So I think that's what I'm trying to do every single day. I fail a lot of times, but still I try to do my bit.
Indeed, indeed. Let me address. Now we've got a full house over here. While we were waiting for you, we were going around asking questions and trying to understand, okay, what is it that we will ask Sonu Sood, okay? Because the elephant in the room is, what is Sonu Sood doing in a mutual fund summit? Like, what's happening? What's brought you here to the financial capital here and talk to people about finance? And while you answer that question, I think the purpose for us to have you here was that we are here talking about wealth creation, we're talking about financial independence, we're talking about so many other things. But a wholesome picture perhaps is also to find the purpose behind that wealth, right? It's to understand how exactly do you invest in what you call is investing in philanthropy. How exactly does one do that? Tell us, take us through your journey, tell us what have been your learnings so far.
You know, the biggest learning that I had, you know, my mom was a professor. She always taught that, you know, Sonu, कि कभी अपनी मुट्ठी खोल कर तो देख शायद तेरी हाथ की लकीरों में किसी की जान बचाना लिखा हो. So I always try to do that, and lately I've realized that, like you said, you know, it's about investing in something that's very close to your heart. I don't know how it happens, but it happened in my life. You know, I remember always. You know, asking my manager that, you know, we have done so many films in different languages, from Tamil, Telugu, Kannada, Marathi, lots of films, but why are we not getting brands to do it? You know, we should get a lot of brands, a lot of advertisements and all. He said, sir, you know, though we are doing a lot of brands, but still we are not getting, you know, a lot of brands, because sometimes people say, yaar, ye negative role karta hai na, so sometimes it doesn't fit into our image. I said, okay, maybe a part of life. And then when the pandemic happened, believe you me, there's not even a single brand in any category that I haven't signed. I signed all those brands, and the best part was that, you know, I pushed them to be a part of my journey. You know, when I signed a mobile brand, so we distributed close to 5,500 smartphones across the country for the online classes. When I signed a steel brand, so we distributed close to 350 e-rickshaws. You know, we signed a LED brand, so we almost did, you know, the whole lighting projects in almost 16, 17 villages in UP, Bihar, Jharkhand. So I realized that, you know, when you give back to the society, when you invest in someone else's life, that's the real investment, and that's the best return that you get. So yeah, that's my journey.
The real investment and bringing a smile on people's face, right? And I like how you've explained the whole thing. It sort of helps the actor, and I'm just trying to, you know, get an objective view here. It sort of brings you a brand image. It also solves a purpose. So that's a beautiful marriage between the two things. So that's, and we don't see a lot of actors, mainstream, do that. So that's really, really lovely, Sonu, that you're doing. But now that we are here and we've touched upon the topic of wealth, I want to understand a few things from you, right? Are you somebody who is an active investor? Are you somebody who takes care of finances on their own? कि ये सब CA पे छोड़ दिया जाता है और बोल दिया जाता है कि this is not my department. How does it work for you?
Yes, I take care of my finances. I don't know how much I understand them, not as much as the people sitting in this room. I wish I could know a lot about mutual funds and investments. Maybe, you know, post my interview, maybe I'll catch hold of a few gentlemen. I'll get to...
बहुत आसान है. There is an app called the Moneycontrol app. You just have to download that. All the information is right there.
No, I'll do that. But अभी live भी सब लोग मिल गए हैं तो पकड़ लेना चाहिए ना. मौके का फायदा उठा लेता हूँ मैं. So, but yeah, like I said, you know, being a Punjabi, what we were taught in Punjab was कि बस property में invest करो. That's the safest thing. So that's what I learned when I came to Mumbai. I invest whenever I get you know, a little bit of something extra. I try to invest in properties. I know this is not a great thing for someone because you can't encash that when you need that. But mutual funds is something that I don't understand, so I have to rely on others. कि सर सिखा दो, बता दो, हाथ पकड़ लो और ले चलो जहाँ लेकर जाना है. So that's what still I need to understand. But yes, I take risks, I would say, when I invest in properties. I remember the first one that I bought was 10 times more than I actually had in my bank account. But I still took that plunge. I said, lete hain panga, you know, and I was able to do it. So yes, that's my forte, you know, and still I have to learn a lot from this gentleman today.
Sure. I think the thing to note for all of us over here is how he so beautifully put it and said that, you know, ye samajh mein nahi aata hai, so you have to always trust somebody. And that's been so much in a sense of the conversation we've had through the morning on how much trust and value add, you know, companies, etc., can bring to the table and what people like perhaps you really need at this point. So that's lovely to know. But tell me a little more about, I'm always very curious to know people like you, who you are, by the way, an engineer by profession. who came to Bombay and then turned life around. And then from that, you're now a philanthropist. You wear several hats, right? But the journey with money must have changed, no? Your personal journey with money through the years, on how you see value in money, on what you really see wealth creation as. Talk to us a little bit about that.
You know, I feel I came to Mumbai with 5,500 bucks. I was the only son of my parents, and they said कि सोनू अगर बॉम्बे जा रहा है तो एक फ्लैट खरीद ले, क्यों struggle करना है, you know, you have everything. So I said, let me go through my share of struggle, through my share of grind, and let me learn that. And so I started from Delhi. So I used to do all these fashion shows and all on 1,500, 2,000 bucks, you know, was a big thing to be a part of a big show. So I was trying to save money so that at least I have a lakh in my pocket, and then I'll go to Bombay, a place where I never knew a single soul. Or maybe 2-3 months I'll survive and then I'll get my first job. So, but that never happened. So I was never able to save that kind of money, you know, in Delhi. So one evening, one of my friends said, "Sonu, aisa hoga nahi. Bombay is a place, you should go." And those 11,500 notes that I had in my pocket, I just came to Mumbai. And I thought that I'll survive for a month. But it took 7 days for that money to end. And I realized ki, boss, this is a tough place to survive. But I got lucky. The same day I got an ad which paid me 2,000 per day for 3 days ad, and those 6,000 helped me survive. And you know, then you know, I could continue with my journey as an actor. But I feel no matter how much you earn, there'll always be a gap. You'll say, yaar, wahan pahunchna hai. That's a never-ending journey. You know, God always keeps a carrot hanging that you keep on working hard to achieve your goals. But then you realize it's not about, you know, getting houses or bungalows or fancy cars. It's about you know, getting content with what you have, and you say कि चलो बहुत सब life में कुछ और करते हैं. And I think जब आप पैसे के पीछे नहीं भागते तब पैसा आपके पीछे भागता है.
Well, that's a good one. So has, like you said, value of money has changed for you. And I think post-pandemic, a lot of us are having that conversation now, right? On what exactly is the meaning, what exactly our goals should be, how should we be defining them. By the way, when you talked about having only 5,500 bucks in your pocket, I was thinking so many people after this is going to tell you, SIP, you know, should have started then, you know when it would have gotten now. So lots of advice will come post the session for you on that as well. But quickly as we wrap this up, just want to understand at this point, where do you see this journey forward? And so many people who can. I'm coming back to our theme of investing in philanthropy. How do you think this can be taken forward? What kind of support do you think is required from industry level, from other people, yours and ours?
You know, I feel, you know, the zeal to do, or zeal to give back to the society is sometimes very short-lived because we are so busy. You know, we talk about, you know, those stories of helping people, or, you know, what we or you can do. But, you know, then again, we go back to your homes and we get busy with your families. Again, we get back busy with their offices, and then that takes a back seat. But I believe that it's very important that in those 24 hours, at least 1 hour, or maybe 2 hours, we should keep a vertical which is only for doing something good. No matter, it's not about, you know, how you can help. Maybe you can, with your driver, with your gardener, with anyone, you can do some kind of a bit and you can slowly grow. You know, I never knew how to send people back to their homes or get them educated or do those surgeries. But I started getting connected with hospitals, you know, pharmaceutical companies, universities, schools, and you know, everything started growing. The most of the people who are still working with me are the ones whom I had helped during this journey. They are not influential, they are not famous, they are not rich, but they have a zeal to do it. So, you know, when we are the blessed ones, we have the, you know, those kind of resources. So I feel that at least an hour of your 24 hours, keep it aside for someone who needs you. And it's a very nice saying that उम्मीद और कोशिश सबसे important words होते हैं. अगर आपसे किसी को उम्मीद नहीं है, so I think you are living an incomplete life. It's not important whether you can change your life or not, but whether you put an effort to do that or not. So I think that's very important for every single individual. Doesn't really matter whether how rich you are or you are still starting your life.
Ummeed and Koshish. Those are lovely words to sort of wrap up our chat on. Thank you so much. Hamare andar ye ummeed jagane ke liye and for everything that you're doing, Sonu. Very many congratulations.
Thank you so much. And मैं कुछ lessons ले लूँगा अभी, but you know I can see those smiling faces कि कुछ सिखा दो boss मेरे को. But thank you so much for having me and
पहले आप
stay
ऐप
blessed.
डाउनलोड करिए, उसके बाद हम.
वो अभी बस बैठ के वही सबसे पहले करता हूँ मैं.
All right.
Thank you so
As
much.
we wrap, I'd like to invite Binoy on stage as well. We've got a little something for you that you'd love for you to have.
Revolutionize and rebuild the roadmap towards becoming a 100 trillion INR industry with the launch of Moneycontrol's marquee initiative. Moneycontrol Mutual Fund Summit targeting 100 trillion. An extensive platform where we shall deep dive and ask questions that must be answered. Spotlight the most enlightening conversations that become turning points and unravel new learnings to invigorate the industry and transform challenges into opportunities. Through meticulously planned sessions, the Indian mutual fund industry's marquee leaders, visionaries and the biggest decision makers from the mutual funds and investment fraternity will bring forth through conversations and panel discussions the Indian mutual fund industry's biggest highlights that scrutinize challenges and opportunities before the Indian mutual fund industry as it aspires to go from 40 trillion INR to a mega 100 trillion INR industry. Through this congregation of the industry's sharpest thought leaders, we will be seeking solutions to safeguard the interests of retail investors and encourage investments in the right mutual funds to secure their future. Moneycontrol Mutual Funds Summit will also shed light on new fund houses. What do they have in store for the retail investor and how they aim to differentiate themselves from their larger, well-established peers. So let's explore the potential our industry encompasses and initiate enlightening conversations to realize our vision of a 100 trillion INR industry. Moneycontrol Mutual Fund Summit targeting 100 trillion.
Riding high on the back of unmatched content and relentless innovation, Moneycontrol has been India's leading business and finance platform for over 2 decades. In fact, we at Moneycontrol have grown from strength to strength this year to become your trusted partner for financial news and opinion. And over the years, Moneycontrol has gone to amplify its reportage to serve its audiences even better. The analytical and AI-based tools give investors the edge to take quick and informed decisions when it comes to their money. The world outside is changing too fast and too often. We therefore have sharpened our global markets reportage. The platform provides a 360-degree insight on why and how you can bet on stocks and assets across the world, and find pockets of safety at home. Audiences have given a resounding thumbs up to these initiatives, and the numbers do the talking. Unique visitors grew by 22% year over year. The Moneycontrol app is again the undisputed leader in its category, garnering over 6 million unique users. Moneycontrol Pro, India's fastest growing business and financial category subscription service, has been listed among the top 15 digital news subscription services internationally. Take control of your money. Experience Moneycontrol.
The Indian mutual fund industry is turning 36. From a recovery mode, it has moved on to become a $1 trillion INR opportunity. And the momentum is right to assess our vision for its future. Moneycontrol, Network 18's flagship digital platform for financial news, has always endeavored to bring the mutual fund industry closer to its consumers. With its wide reach and association with industry experts, it has also been a knowledge-sharing platform that breaks down the fundamentals of mutual funds, encouraging the common man to transform into a confident investor. Now, as we step into a new year, we are getting ready to rethink, revolutionize and rebuild the roadmap towards becoming a 100 trillion INR industry with the launch of Moneycontrol's Marquee initiative.
All right, I hope everybody got a good little break and selfies and some coffee perhaps. Okay, so we'll get back to the conclave and the panels that we've lined up, keeping the knowledge-sharing agenda of Moneycontrol Mutual Summit on. We're glad to share with you the launch of a very interactive and informative tweetathon series powered by Mirai Asset MF and KFin Technologies, coming soon on the Moneycontrol Twitter handle. Now moving on to our next topic of discussion, the performance of active mutual funds, which seem to have an inverse relationship with market returns, as chances of outperformance increase during periods of lower market returns, as shown in an analysis done by Kotak Institutional Equities. While active funds provide better downside protection during bear markets, strong bull markets tend to bring in lower volatility and higher correlation among stocks, making it more difficult for active fund managers to exploit their stock selection skills. But the question remains, does the mutual fund construct give enough room to generate alpha, or is size a problem in generating superior returns? Our next panel has all the answers for you. Please put your hands together for our moderator N. Mahalakshmi, Senior Consulting Editor, Moneycontrol, and the guests for her panel. Mr. Nilesh Surana, CIO Equity at Mirai Asset, R. Srinivasan, Head Equity SBI MF, Anup Bhaskar, Head Equity IDFC MF, and Sankaran Narayanan, CIO ICICI Prudential MF.
It's an absolute delight to be moderating this panel. And the topic for discussion, as Karunya said, is maximizing alpha in the age of alternates and indexing. So on one side, there are the passive products, the index funds. On the other side, you have absolute return funds, which, where assets are absolutely fungible. You can do pretty much as you please to generate that alpha, and mutual funds are pretty much caught somewhere in between. But before moving on with that discussion, I want to make 3 points which will really set the context for this discussion very clearly. The first point is, over the last 10-15 years, the mutual fund industry has really grown tremendously in terms of size. So I was saying, I was started off my career with mutual fund industry. Back in those days in the 1998, 99, pretty much barring that 2000 period when the dot-com crash happened, before that pretty much 90-95% of the funds would outperform the market. And I'm not talking about the assured return products of those days, the UTIs and the can bank funds and the BOIs and BOBs of the world. But the private sector mutual funds, pretty much 90-95%, there will be just 1 or 2 exceptions to that, but everybody pretty much outperformed because the size of the industry was really small. And of course, all of these smart people were managing money. They still do, but the marketplace has changed. The reality is that in a much bigger market like US, the last time I saw, 86% of the mutual funds, actively managed mutual funds, underperform the market. And this is, we've not gotten on to that stage. Mutual funds, as a proportion of total equity, is less than 10%, so probably we are not going to get there very soon. But that's one thing we cannot really take our eyes off. That's point number 1. Second point is the institutional framework within which the mutual fund the industry operates. And I want to quote Keynes out here, where he says, worldly wisdom teaches us that it is better for reputation to fail conventionally rather than succeed unconventionally. And Naren would relate to that very much, and I'm sure a lot of others will also relate to that very much. But they all know the constraints under which they operate. So this is the second thing which differentiates the mutual funds institutional setup versus what is emerging as a very competitive, where the competition is really coming to this industry from. The third point is the trade setup itself, which I think is a more short to medium term phenomena, where the markets themselves are highly overvalued. At least that's what I think. They may differ. And across the board, valuations seem slightly elevated. And the pockets of opportunity are, if stocks are cheap, they're probably cheap for a reason. Therefore, the overall macro trade setup also is not really conducive for very high level of alpha generation. This is my take. So these are 3 points that we need to take cognizance of, and this sets the backdrop for the conversation that will follow. So I'll start off with Naren. And today, in terms of size, and you also manage some of the largest funds in the industry, how big a problem is size in generating alpha?
Actually, one is you have to decide what kind of fund you want to run. And if you decide that you're going to become a closet indexer, and then it becomes a problem, because then you have to beat the benchmark and the kind of expense ratios that exist, it becomes a problem. So what we at ICICI Prudential decided is that we have to focus on hybrid, because in hybrid you are a provider of liquidity when the markets go down in a way. And that becomes very easy then. So in 2020 March, we could end up buying 10,000 crores of stock. So then, this whole concept of, are we large? Frankly, if instead of 10,000 crores, we had to buy 20,000 crores also in March 2020, it wouldn't have been a problem. So the size became not an issue at all, actually, because that's one of the reasons why we chose to focus on hybrid as a category, because size just did not become a factor at all. If you go back and think of March 2020, you would have realized that very, very clearly. The second is that finally at the end of the day, each fund manager has to choose what kind of style works. So if you look at our firm, like I enjoy being a contrarian, and when you're a contrarian in today, particularly today when as we speak, almost every PSU is going up at the rate of 10% a day. And go back 2 years back, the question that was asked of me was, do you think PSUs will ever go up any day? And that question, and you had to explain to people that we will cap PSU weightage in this fund. And there were so many people who used to come and ask, will you cap PSU weightage to this? You will not exceed this, no, at any cost. So, and today we have a opposite situation. So by being contrarian, it becomes easy in the long run. The problem is that people sometimes, if you look at people, they look at SPIVA and say, okay, in the last 1 year, have you outperformed benchmark? The more freedom that is given to people, that you will not have to look at benchmark on a 1 year basis, it becomes very easy to outperform benchmark on a longer term basis. But then that freedom may be more easily available to me because I have been there for long. But is that available to everyone? I do not know. So in between, what we did at ICICI Prudential along with hybrid and contrarian and special situation was we tried to launch closed-end funds. But then today we find that it's not easy to get approval for closed-end because what the regulator says is the fund has to be different. I don't think it's easy to find a different type of closed-end fund. But closed-end would have helped us a lot because in 2020, most of the closed-end funds that we were running were actually defensive prior to COVID, and we became aggressive post-COVID. So closed-end, one of the things we learned from the ultimate guru Warren Buffett and Charlie Munger was, if you're closed-end, what happens is it enables you to be rational when the markets are irrational. But today in India, there are hardly any closed-end funds in the mutual fund space. You may have it in the AIF space, but you don't have it in the mutual fund space. So these are the ways in which we have navigated. But if you decide to be very conventional, then I think size will become a challenge. So how can we become unconventional? So what you do is you try to launch a business cycle kind of category, which is top-down, bottom-up. So you try different things actually so that scale doesn't become a challenge, because top-down becomes very easy to buy when again you will have distress. Suddenly one day Fed will do something that gives you an opportunity. Then Fed will do something else. That will become an opportunity. Something will go wrong in China. That will give you an opportunity. So essentially, scale is a benefit provided you're contrarian. And scale is a big problem if you're momentum. And that is what we realized. And that's why we are focused on hybrid, contrarian, and that kind of framework is what we decided as a house to focus on. And because finally at the end of the day, a mutual fund wants scale. We don't want to be a boutique. And that is the way we looked at it.
Sure. Srinivasan, you also manage some of the large funds. Do you think in today's environment you have to be a contrarian to be able to deliver alpha?
In the short term, probably yes, but I don't think so. If you're a long-term investor, so the contrarian philosophy, I think, is basically being cognizant of valuations. So, are we cognizant of valuations? Yes, we are. But beyond that, I guess you don't need to be I don't think you need to be contrarian to generate long-term.
And at what size do you think size can become an impediment, if at all?
Well, I think size is always an impediment. The larger the size, the lower the investable universe in terms of the number of stocks. The larger the size, the higher the illiquidity. You need liquidity not only from being able to buy a certain position, but also being able to exit a position if you go wrong. So depending on what category you are, I guess if you're in the large cap category, Size is less of a constraint because you're operating within a very liquid universe. But if you want to generate alpha size, so we think we're constrained on size on a small cap category at almost $1 billion, probably less.
Sure. Nilesh, you probably don't worry about size as much, but one of the points that Naren pointed out was that his long experience with the company gives him that elbow room to be a contrarian when he wants to be. Now you have a fairly long track record of performance, but maybe not as long as Naren's time in the industry. Do you have that elbow room, and does an average fund manager really have that?
Old man, Naren.
Does the average fund manager really have that elbow room to be able to navigate the market the way he wants to deliver alpha, of course?
Yeah, I mean, if I look at the overall perspective, I mean, this debate of outperforming and the benchmark up to 2015 or so, 16 was not as much. If you look at, even today, when you look at large cap category on a 10-year basis, the median or 80% of the funds, they are outperforming. The problem is last 5-7 years. Until 2015, if you see the record of, let's say, a median return or the category return, 10-year return, the alpha was 300-400 basis point in large cap. One is, if you look at what's happened at this point in time, I think the attribution analysis of why a median or an average fund in large cap, the alpha has come down, if purely on attribution analysis, is actually related to few stocks or groups. If you look at last 3 years, it is related to one particular group where the industry is under index, under owned. That explain about almost 1-2% sort of, and not difference is not much. So I think that doesn't mean the liquidity is an issue, but I would fully agree with Vasan that particularly that mid-cap, small-cap cannot be a very large significant because markets are illiquid. I think the construct of Indian markets, see, alpha generation at the end of the day is a zero-sum game. If you look at mutual fund is about 8% of the industry, retail is about 8% of the industry. So what was the sense about 5 years back? Retail was 16%, mutual fund was 4%. All else being equal, while information, slight advantage is there, analysis, behavioral analysis is there with professionals. So if there is all else being equal, the institutional or the fund managers, they would probably have a better sense of identifying stocks and all compared with retail. Whereas as you touched upon US and all, literally entire market is institutional. Promoter holding is very less. So if you put it that zero-sum game, then 50% will outperform at the expense of remaining 50%. So I think there is still that construct still remaining that active funds can sort of outperform vis-a-vis. The alpha probably could have diminished, but still 100-200 basis point is possible even for large cap, just like what we are seeing results on a 10-year basis. So long answer, but I think the attribution suggests that it's more to do with few factors, earlier a particular group, one particular company, couple of names in finance sort of thing, quality things. For last 3-4 years has been pretty erratic. But I would not blame it only on size, except for small cap or mid cap sort of category.
Sure. Anup, what is your sense?
No, I think so. It's getting more and more tougher. There are more people doing this. So than what was the case 15 years back. So in terms, information gap which was there and which helped all institutions is now practically zero. In fact, we have got more, problems to get information than the case of others who are not so much regulated. Second, I think so, is that some of the conventional winners which have given us alpha over the last 10 years. So in 2008, if you were to remember, just the weight of HDFC Bank was actually less than 2%, and almost all funds had weight of 4-5% in their portfolio.
Right.
Pharma was a sector that most people didn't want to own, and you were slightly overweight on pharma between 2010 and 15, and you got all the alpha. So you had very distinct pockets from where you could get over, this as such. But over the last 5-7 years, the market has become very flat. And if you miss out 1 or 2 pockets which have done well, you can't generate alpha as such. So one is that competition in terms of small caps is very intense. Today, if you were to listen to a small cap company call, 80% of the questions are asked by people who are not from mutual funds. which is something that I would have never imagined in my lifetime would happen, because we thought that we were the ones who were the chosen ones to get all the information from management and not somebody who works in a PMS or AIF. So there is a huge amount of competition, at least on the small cap fund. I don't think so it is size which is the factor, it is flows. If you have a fund which is very large in size and it suddenly starts bleeding, and it will bleed only when you have not done well, that it won't bleed when you're doing well, and when you're not doing well, you've made some errors, then it becomes difficult. So it is flows, I think, so you should focus more on rather than size. So today in small cap, one of the best performing fund is the largest size fund in small cap. So therefore size doesn't really matter. It's at, and its size is 22 or 23,000 crores. Size gives you a lot of benefits. In the last 5 years, one of the largest source of alpha has been the case of IPOs. If you are a large fund, you get that alpha. If you are a small fund house, you are consigned to 2 crores, 5 crores, and in good issues, you're not even there. So some of the alpha which comes in small cap or mid cap has come from the case of IPOs, which are given to the top funds by their size, which they can't wish away from.
But there is the other side also, Anup.
Yeah, of course.
There is the other side of the IPO game also, which some of them have experienced.
Yeah, that I will whine for the things that really hurt me. I will not go and support the things that don't. But the thing is that you have the option to get the kind of allocation that you want. If you are a small fund house, the rule that we now have that, given our size, that if we get a call second time from a merchant banker, then that IPO is not going through. So, then you just stay away from it. Because if it is good, then they won't call you. Because if you're 15th ranked player, who's going to call you for that? So, that is one point which is there, in terms of size is very important. So I think, yeah.
Sure. So one of the points Anup is making, obviously, is becoming very clear in the market that the information asymmetry is really gone down quite substantially, Naren. So does it then really become a behavioral play? Because the only way, there are only two things. Either you play on information asymmetry and mispricing therefore, or you play a contrarian, because behaviorally you feel that, okay, the market is not willing to look at this opportunity, but I have the gut to look at this opportunity.
It's nice as a country to see that if information asymmetry goes away, it's great. All annual reports are on the web, all transcripts are on the web. So it's great as a country to see that. That's what I mentioned, that it's a lot of it today is behavioral asymmetry. Behavioral asymmetry doesn't go away. Yeah, even in US.
So that is the real edge.
That's what gives you the edge. Even in a country like US, you look at the kind of extreme valuation you saw in 2021 in the form of SPAC and loss-making companies getting listed at ridiculous levels, etc. So I think it is only through behavioral asymmetry that we can actually manage, because information asymmetry is steadily going down. And that's a very good sign, because if we go back to our 80s and 90s, information asymmetry was the biggest source of alpha, and that has gone away. I think it's very healthy for the country in that sense, and we have to thank the internet and channels and Moneycontrol and various other things for this.
Sure. So back to the same old question, that does the institutional setup in the mutual fund industry allow you the liberty to, have those behavioral traits, which is independence of thought, taking your call, being a contrarian? Does the setup even allow you to do that and leverage that as an edge?
Yeah, absolutely. No constraints at all.
Is that true, Nilesh? I'm hoping you'll say a no.
No, in the sense...
I run a fund which has 20 stocks, and I don't think we have any constraints per se. There are investors behave, so investors are worried about short-term underperformance and they withdraw money. That could be a problem, but that's an occupational hazard. But I haven't seen that actually being a meaningful problem so far, at least.
I'll ask you why I'm skeptical, but Nilesh first.
No, I don't think so. The industry has matured they look beyond 1 year number. They are looking at 3, 5. The entire ecosystem is giving that much rope. That is one. And second is, I mean, over time, some of the active distributors, they are actually looking at active share, etc. So that's an important metrics, whether how much you are deviating from benchmark.
Yeah.
And as long as, let's say, FT share is, if it is less than 40%, one can worry. But if it is 60, around 60, 65 or more, that means that fund manager is taking, then the better ratio is to look at information ratio and all.
She's asking, are you
So
constrained to manage
so
money?
that's what I was about to come to that, because the active share, I just looked at the Morningstar data this morning. Active share for most funds, except Taurus has some bizarre 80% or something, but most other funds are like 50 to 60%.
Yeah, so that, see, we don't benchmark for the sake of benchmarking if you're seeing an absolute downside. So if some part is benchmarked and we are seeing conviction in that, there is no harm in that, number one. Number two, actually, you can fairly outperform with a 60%, underperform with a 70%, because active share increases the risk also. So if your question is, are we constrained? I don't think so constrained, but the fact of the matter is, our job is to beat the benchmark, that's first part, and then relative returns to peers, and then absolute return. Investors may look at, different set of investors will look at that. So how much active one should be active is also a function of the risk management of the fund management side. Anything less than whatever 50, 40 to our mind is not right, but anything more than 60, 70 is slightly taking higher risk, which means that if something were to go wrong, or something like events like COVID, or even longer term something were to go wrong, can pull down also, which we cannot sort of afford. But I mean, the answer I think is there is enough leeway given by the ecosystem where one can take reasonably risk-adjusted active share and to outperform. So there is no throttling by the system which is constrained. So I think still the underperformance which we are seeing, at least in our case or whatever the industry case, is more to do again with few stocks, few sectors, as Anup also sort of which has happened. I mean, one group, people benefit for 5 years, then again, the entire industry was under index, something like that.
Sure. Naren, back to you. Do you think this is, you know, especially Srinivasan and Nilesh are saying that the active share is 50% and that's good enough for you to create outperformance. Now, the competition to mutual fund industry, where it is coming from, whether it is PMF or AIF, those guys don't work with this kind of framework. Do you ever feel that that is becoming a constraint across the board?
I think the fact that after 2000, for a long time, we have not seen a fall sustain. And the fact that you have not seen a fall sustain and you have had only positive markets all the time, that has created a certain sense of complacency among everybody in the system, whether it is investors, wealth managers, distributors, mutual fund salespeople, everyone in the system. And we will have to see one fall in the market, and if it sustains and the market stays down, how people behave. So I think the entire PMS AIF industry has grown up only in bull markets. And we'll have to see whether it lasts one good correction and how it behaves at that point of time. And so I think it's too early for us to worry about everything, because I think, you know, everywhere in the world, 2022 was a wake-up call because the markets corrected. Even in US, most of the investors have been shaken up. Forget China or Taiwan or Korea or Japan or Europe. India is the only place where the investor believes that if you invest in equity, you'll never lose money. So I think that view exists. So we have competition from everybody today. But I think, you know, once you have at some point of time, you know, today if you have had 6-7 years of no negative return in Nifty, it's everyone believes that you will never have negative return. So that kind of behavior is a worry. And you have a lot of money not going into debt because people believe, why invest in debt? Anyway, you will get positive return in equity. And that is a risk at this point of time. Let there be some negative return and it sustains. Today people believe even if March 2020 happens, April 2020 will immediately come and markets will recover. So that kind of thinking has settled very, very closely. And for people like me who have seen 90s, that is very worrying actually. And that's why right now I don't worry about PMSAF. If after a 10-15% correction which sustains, if that industry actually does well, I think they have arrived. Then we have huge competition actually.
So good you raised that point, because one could say the same thing about the mutual fund industry also. You know, today how much elbow room does a mutual, of course we've made a big deal of this true to label. How much elbow room does the mutual fund manager himself have? If, for example, you're circumspect about markets today, do you have the liberty to go in your funds 50% cash, 60-70% cash if you're negative on the market? Because that's what is going to make the real difference to the average Joe who's given you the money and says, you know, make sure that my money grows and it doesn't go down.
This is the job of the wealth manager and the investor, because we have created so many asset allocation funds, we have created so many hybrid funds, and we have made them very large and made them big mascots so that they are invested defensively. So if the investor wants to invest in the most aggressive funds, it is the investor's problem, the wealth manager's problem, and the distributor's problem, not my problem.
Anup?
See, protecting the downside is remembered only for that period of time, and then everybody wants to participate in the upside. So we had launched a small cap fund, just in terms of February 2020. We were, 30% invested in the month of February and early March, and then March occurred. So on March, 23rd, we were doing very well, and on March 31st, we were last, because in 7 days' time, markets turned around, and everyone questioned why didn't we go and just go and deploy the cash. So we said we'll take the 90 days to deploy cash. So coming to your point about trying to protect downside, I think so people go and put money in equity market for the upside, not to protect the downside. So, this is one thing I have learned the hard way, whether it is 2008 or it is 2020, you can't worry about Armageddon. You have to get invested because your key investors, your IFAs, your distributors, want to participate in the upside. They will give you sweet words if you fall too much, but they'll give you, that even more sweeter words if you don't participate in the upside. So while it's nice to believe that you protected the downside, so we were at NAV of 8.5 in that fund, and average small cap fund was down something like 32%, or I think something like that in that month's time. But the next month there was a recovery, and there was a clamor on why we had not got fully invested in 15 days' time. So it's a tough call. I have done it twice. In 2008, we were among the first to hold cash, and in 2009, we were the first one to be berated why we held cash. Actually, that is one strategy I would not want to do the third time in my career.
Sure. Srinivasan, does it weigh on you that that the market could fall, 15-20%? You might be circumspect about it, and yet in your fund, you're not able to go aggressively in cash and save that pot of money for the investor?
No, I think market timing is overrated. I'm sorry, I disagree with Naren. I think we consider ourselves largely as relative return investors. We're very clear, and we tell that to investors. We run a few asset allocation funds, but I think we believe that the probability of getting that market timing right is relatively low, and I don't think I'm worried about the market going down. So if the market goes down 40%, if I go down 30%, I'll expect the investor to stand up and clap for me. He won't, but that's how we operate. He won't, but that's how we operate. We're very clear about it. I think, like Naren also alluded to, the allocation part is the intermediary's job. He has to figure out. I don't know what allocation the client needs to have. I'm presuming that if he's come into my fund, that's his equity component. He can always choose to put 10% of his money in equity and the balance 90% in debt. And I need to manage that equity component such that I definitely outperform the market over a long-term basis. And if I need market share, I need to outperform all these guys too.
Fair enough. One final question on the markets itself, Nilesh. Where do you see pockets of opportunity?
So, markets have, all of us know, done reasonably well, relative, absolute basis. So I think one is how the economy and all, so that things are looking very good. I mean, some of the, of course, global market, there are issues, and I think inflation, I mean, the commodity energy basket has come down. but markets have probably reading that and all. So most of the earnings which would recover and all is being priced in. So I think the opportunities would be not so much on multiple expansion, but be in sync with earnings growth and more from a longer terms, not on a 1 year basis, 3-5 year basis. If the expectation is low teens, there are opportunities in sectors which will mean revert. A lot of opportunities in that Make in India theme. For example, banking is still, while it is moved up, but still probably in sync with the earnings growth it could sort of give. Pharmaceutical is not very sort of expensive. So, but for certain high price sectors like capital goods, which is actually longer term volatile, but and very expensive, I think by and large, even quality part is, some part of it is time price corrected. So there is an opportunity with the lens of making low teen sort of return from a 3-5 year perspective in many of the sort of cases, because economy actually is looking very good, but markets are not so cheap. Yeah.
Sure. Is that the same portfolio positioning that you have?
Sorry.
The portfolio weights. I mean, he's very bullish on financials, capital goods.
Yeah.
What are your...
Yeah. We are overweight.
It's expensive.
Sorry.
We are overweight financials. We're also overweight industrials.
So that's one question I wanted to ask. Yesterday I was seeing that overall mutual fund industry is about 400-500 basis points overweight on financials. Now, if the whole market, at least the institutional setup, is
overweight, I doubt that number is right. Because financials are like...
BOFA report said that institutions are 456.
Financials are 40% of the benchmark already. I doubt mutual funds together will be 45% or so. I don't think.
450 basis points, so 400 basis points.
So they'll be 45% of mutual funds will be in financials? I doubt.
No?
Because the mid and small cap funds don't have financials. The Nifty has 40% financials. So you'll have the large cap funds probably closer to index weight or overweight. The mutual funds as a whole will definitely be underweight if you ask me.
Yeah, okay. So financials is your top pick. What else?
We like industrials. I agree with Nilesh that it's expensive, but we don't think we have the liberty to get out and get in again. So we continue to own. We'll sit through the underperformance if there's anything. And we own a lot of Bharti, so that kind of makes us overweight in communication services. That's not really a sector call. And selectively, we are overweight healthcare.
Okay. So that's an aggressive kind of posturing. It's not defensive posturing.
No, actually, I think it's a defensive posturing. Because financials, I think, are defensives right now, in the sense that all these banks are very well capitalized. They haven't done anything.
In terms of valuations, I guess. Relative to the rest
relative, yeah. Plus, they haven't done anything in the last few years, so they can't screw up in the next few years. And you see a cycle coming. Healthcare is defensive, so yeah. Industrials are generally high quality companies. They're expensive for sure, but
okay. Arun?
Pharma is one where, because it's done badly. Auto is another which has done okay recently, but done badly on the long run. And financial seems to be a consensus.
Yeah.
Along with everybody, we also have good amount
need to sell now because you're contra.
So these are the things which we have.
No, I just want to own companies where they're going to be, so first that in terms of sectors, we have the same sectors as what others have, but I think so, more importantly, that is, going to be more dependent, on earnings growth. And companies that are able to surprise on earnings are the ones which will survive. And companies where there is some kind of disappointment or it's in line, market, can be very, very strict on that. So we are trying to avoid companies where the earnings growth is a bit mixed and try to focus more on where there's some element of surprise still left in terms of earnings.
And where is that?
We try our luck. If we get 5 out of 10 right on that, I think that's a good forecast to have. And it will be around these sectors only. It's not it's not outside these sectors.
So if you succeed, all of you succeed. If you don't, all of you are going to underperform. because there is so much consensus except, I think, industrials, capital goods. There is hardly any difference. All right, we've pretty much run out of time. Thank you so much, gentlemen, and this was a lively discussion. I hope you enjoyed.
Okay, moving on to our last panel of the evening, brought to you by Abhi Loans. We shift our focus to new fund houses, the opportunities to differentiate and innovate on products, and what is the minimum corpus required to sustain and make reasonable returns on equity. For all that and more, please welcome our elite guest panel, Mr. Rajiv Shastri, Associate Director and CEO, NJMF, Mr. Ajit Menon, CEO, PGIM India MF, G. Pradeep Kumar, CEO, Union AMC, and Sandeep Sikka, Executive Director and CEO, Nippon Life India Asset Management. And to moderate the panel, Mahalakshmi, I would like to invite you back on stage.
Hi, this is going to be an interesting panel, very different from the previous panel. And taking off from where Kezad left, we'll take off from there. And there were very interesting points that came out in that discussion also from Radhika and Neil Parekh. You guys were not there, where they talked about their strategy, challenges, and opportunity for new fund houses. Again, I think before coming here this morning, I just looked up the top 20 mutual fund houses in the United States, and let me read out the names, okay? Vanguard on top, BlackRock, Fidelity, Capital Group, Amundi, Wellington, Invesco, Franklin, T. Rowe Price, Geode, Blackstone, Schroeder, DWS, Legg Mason, Brookfield, and many more. How many of them are in India? 2 or 3, maybe 4. What does this tell us about the mutual fund opportunity in India? And that's really a genuine question I have, because you look at any industry in India, over the last few years, there has been so much clamor for, big companies to come to India because of the demographics, because of, whatever market that we offer. Mutual fund industry is perhaps one of the very few industries, I can't even think of the second one, where foreign investors have come in and they have gone out. Most of them who started off here have also sold out their businesses, and one man out here has helped them sell out also. But there seems to be more optimism amongst the domestic guys. Now, NJ is, of course, on this panel, the newest fund house. There are more coming, Zerodha, Samir Arora. Of course, for him, it is just a homecoming. But there is more optimism amongst the local guys compared to the big daddies, who should ideally have the time and patience and capital and everything that it takes to establish the business out here. So what are we getting wrong out here? I'll ask the big daddy Sandeep Sikka first.
So I think, firstly, let me congratulate Moneycontrol for this great event. I think the theme that I was seeing, the 100 trillion, is very interesting and coincides with a very interesting another number. I think we're at a very interesting juncture where first time in India, every Indian is investing 100 rupee per month in SIP. I think we've achieved this feat, after a long time, and this is happening with only 3% of the population investing in mutual funds. Now just think of this 100 naturally will become 200 or 300, because as the income levels go up, and 3% of population investing in mutual funds will go to 6% or 10%. So I think we're looking at a scenario where industry is going to do well. And secondly, I think the way I see, especially after hearing Sonu Sood, just what struck me, I think we talked about a lot of work that he's doing for the society. This industry also, I think every person associated with this industry should thank the investors, because when somebody trusts with their money, it's a very big thing. And today, the 5 crore investors are investing this in trusting this industry. So let me now come to your question. I think I've been in the industry I've been with the company for 20 years.
Right.
And so it's very interesting. In these 20 years, the number of players have almost remained the same. We've had roughly between 40 to 45 players. We have seen about 20 exits. Exit, sold out, M&A. We participated in it, we have acquired. However, this question keeps coming up. I remember when I was the AMFI chairman, at that point of time, 2 foreign asset managers went out of the country, and this question came to me from some friend in media like you. Do the policies in India help the Indian asset management companies? And at that point of time, I mentioned there's nothing called Indian asset manager, new asset manager, old asset manager. This business is very simple business, and the most difficult thing to do in a simple business is to execute. And I think if anyone who's been able to execute it well has been able to scale it up. And from our perspective, the way we see things is, I think it's not about foreign asset managers. A lot of names that you took, 20 years back, all the mutual funds which started were new mutual funds. Many of those were foreign names. Some survived, some did not survive. Some domestic names were there, which some survived, some did not survive. But I think when I look back, the biggest differentiation between the companies which survived and did well was they were able to find the niche for themselves. They knew what they wanted to do rather than being a mass player and do multiple things. For us, for when I see myself, in 20 years, I see 21 into 20. Every year we have to relook at the strategy. And to be successful in India, it's very important to be very nimble feet. You have to change your strategy. For us, let's take, I think, in Gujarat, 3 cities of Gujarat, we have different strategies. Investors in Rajkot are very different from investors in Baroda to investors in Gandhinagar. Now, if you don't have different strategies for them, I think you are bound to fail. A lot of foreign asset managers, the marketing was decided in Hong Kong, the fund management was done out of London, and the strategy was done from Boston. And it doesn't work like that. So to give a long answer to a short question, the opportunity is big. The key lies in execution, and anyone who could execute has been able to be successful.
That's a very interesting thing you said, that the investor in Rajkot and Baroda and Gandhinagar are different. I would want that insight so that we can grow Moneycontrol also better in these cities. But that apart, Rajiv, you are the newest player in the industry. Of course, you have something very interesting to leverage on, which is the NJ distribution, which you have done. But that apart, was that the only factor, or was there anything bigger that motivated you to get into this business, especially looking at how the stock markets are treating asset management companies these days, and generally to see the return profiles of these companies, I mean the big companies coming down? What led to that optimism?
Okay, so we are new to the mutual fund industry, not to asset management. We've been in the asset management space for about more than a decade now as portfolio managers, and we are among the largest in the country. So we had that background. We've done only factor-based investing through this period of time, and we've put in the effort that is required to to build up the capacity for that, including databases and including our skill sets. So you require a very different set of skills to manage money based on data. So we've done that effort, and our optimism was driven more by the fact was that there was no one who was doing it in a dedicated manner, and we believe that this is something that we wanted to take to the retail investors. So the optimism that came, it's not just an opportunity, it's not just a niche for us, it's something that we believe in very, very strongly. And we believe that this is where, I'm not saying that it's going to be, it's us versus the rest. I'm saying it is a complementary strategy which does not exist in a substantial way in this country, and we wanted to bring it to the masses. So that's number one. So having our own distribution business, which is what it looks like from the outside, let me just tell you that, to all the people here, they obviously know that NJ as a distribution business is not, like any other distributor. It comprises of thousands of partners who make their own decisions whether they want to sell a product or not. So it's not as if someone in NJ can tell somebody that now you go out and sell this product now. It's not like any other, formal distributor. It's a very, very open system. Everyone decides, 20, 25,000 active partners. They decide who they want to support, who they don't want to support. So, though that is a huge benefit.
Is this like the Swiggy having their own kitchen versus other restaurants on that thing? There is a lot of skepticism with which you view Swiggy's kitchen when you see that restaurants are logged onto the platform.
Well,
I'm sorry, I had to ask that.
No, not really, because it's an open platform, right? So we are allowed to have our own product, right? And if people prefer to sell that product, so be it. Sometimes they may, sometimes they may not. I mean, it's not as if they're beholden to sellers. It's not as if they're obligated to sellers. There's no such obligation across the organization. So it's not as if we are entitled to the support. Like every other participant in the industry, we have to earn it. So that's the second part of it. The third part of it, and coming to your first question, what are we missing out? What are we doing wrong as an industry? When you say so many foreigners have come and gone, not many people are coming in, the top 20 are not here. Let's look at this industry. You're talking about 100 trillion. I think it's going to happen in less than a decade. That's my belief. I think the mutual fund industry is growing at a pace which is incredibly high. It's going to grow at a pace which is, much, much higher than what you've experienced so far. Okay, because there's, when we talk about compounding, the human brain comprehends compounding in a certain way. So we say our economy is going to grow at a nominal rate of 12%, so every 6 years it will double. That's something that we can absorb. But when we say in 15 years' time, it's going to be 8 times, okay, that suddenly comes as a shock to people. Like, how can it be 8 times? It's only double in 6 years. How can it be 8 times in 15? So stuff like that happens. But when you're looking at exponential compounding, which is what we are going to experience, right? Our economy is growing at 12%. An economy which is growing at 12% at $2,000 per capita GDP, when the next $500 comes, the savings rate is going to be much higher. Of that savings rate, financial savings are going to be much higher. Of those financial savings, mutual funds are going to be much higher. So there's a rate of growth that is becoming exponential, and we will grow at a pace which no one can imagine. So to me, the question is not what are we doing wrong. The question is that why are they getting it wrong? Why can't they see the opportunity?
My question is, what is it that you see that they don't see? Because
this is what I see, which I don't know why they don't see it. Because if they would see it, they would be here in droves. We've had 60 participants today. I don't see why they don't see it. And what Sandeep said was absolutely right. Execution is key. Cost control is key. It's a difficult market to be in. It's a market where you need to count the pennies. As a CEO, okay, what I do control 100% is my costs. I have no control over where the markets are headed. I have no control whether people will like my product or whether they won't like. I'll make all my efforts to it. But I have no control over it. I have no control over the outcome. I do have control over my costs. And if I can focus on that and at least focus half my time on one side of my P&L, right, and focus half my time on the other side, creating that opportunity for myself, creating that space for myself, I think that is where most of the big guys, most of the foreigners who came in, I think that's where they faltered. Their costs were ridiculous.
So what are you gunning for? A product-centric approach which gives you an edge over the others, which you will build on at some, as you go along? Is that the bet?
Given the outlook that we have, it's not about an edge over the others. So that we're very, very clear on. Because there's enough opportunity for everybody and more. We hope more people come in. It's not a product-centric approach.
That's also a good tack to take when you come, when your parent is the distributor.
No, but I think, the entire industry will vouch for it, that I don't think anyone of, the industry participants who work with NGA have felt as if there is a favor that is happening. So I think the industry would vouch for it, right? Also, we are not looking at a product-centric approach. We're looking at a philosophy-centric approach. We believe in factor investing. We believe that it is, important that investors in India have a participant which dedicates itself to creating the capacity, to creating the skill sets that are required to optimize, the investing based on factors. And that is the opportunity that we see. The market opportunity is there for everyone to see. That's not unique to us. And my only problem is that, if foreigners don't see it, if the foreign participants don't see it, then honestly, I think they are the ones who are getting it wrong, not us.
Fair enough.
I think Sandeep wants to add something.
No, I think again, I'll just add, I think it's very important. It's not about product, it's not about distribution. I think this industry offers so much opportunity, and I have always believed it's very important to identify what not to do. I think what a lot of players, especially, I mean, the domestic or international who exited or closed the shop, was they wanted to be everything to everybody. So I think, I mean, what Rajiv talked about factor. So I go back in 2016, we acquired a company wherein we started ETF business.
Yeah.
A lot of my colleagues from the industry at that point of time called me and said, I think it's the biggest blunder I'm doing in my career because we live in a world we are tuned and mentally, you know, we are made to believe alpha is everything, what you were asking in the earlier panel. Yeah. I think as a CEO of a company, you have to believe that I think we have to do, we are here for the investor, let the investor make that choice. And was ETF at that point of time, does it make less money? Answer is 100% yes. But we are not the ones to decide. I think we have to keep the investor in the center and let him decide whether he goes for active or passive. And every person in the industry, I can tell you, since morning you have met, because this industry was built on the backdrop of alpha, it's very difficult to believe that that thought process has to be disrupted. So I think the point I'm trying to make is we'll have to everybody, even if we are an established pair after 20 years, we keep pinching ourselves and say, what is going to disrupt us? And there are so many opportunities in India. I think the worst thing you can do that you say, I want to do everything. So I think that to the point, whether it's a product differentiation, channel differentiation, something you'll have to do. Otherwise, I think you'll get lost. And I think you'll be again history.
Sure. Pradeep, let me get you in here. So when you think about your company, the way you have thought about your company, did you think about differentiation? Did you think, I mean, what are the factors that you really think about, given the fact that you are a late entrant into this industry? And it's not just in mutual funds. Anywhere you are a late entrant, you have to be different to ensure that a challenger has always to demonstrate differentiation to be able to disrupt something. So what was the thinking and what has been your journey so far?
Our journey has had two chapters or completely two different parts to it. So when we started as a joint venture with a European company, we faced some of the problems that you alluded to earlier, right? What is it that the foreign guys get wrong? And we had this experience of, a classic case of how wrong you can get with execution, right? So we had a company which had a model where in Europe, their mutual fund products were sold only through their own bank, right? And it works brilliantly for them. They had a 40% market share in that country. So they thought, why not do this in India? So, they tied up with a public sector bank, large public sector bank in India and said that, yeah, you do this in India, you sell only through this public sector bank, right? I don't have to tell you, what happened with that strategy. So that was one part of it. But there is a very interesting learning also there. Right from day one, we were very clear. I told everybody that we are not trying to eat into anybody else's business. This ocean is so vast that there is enough for everyone to grow. So with the network that was available to us, which was the Union Bank network, we managed to add a significant number of new investors. On an average, I would tell you in those years, about 65 to 70% of our investors were first-time investors in mutual funds, right? Which I consider to be a very good achievement. It just shows, what can be done if you can reach out to more people. Our bank was not a very sophisticated seller of mutual funds. They were just like any other public sector bank. But the point is, they were able to reach out, right? So to give you a perspective, if I took, particularly a couple of years back, the top 10 cities in terms of number of investors for us, some of the cities that would figure, Varanasi, Gorakhpur, Jaunpur, Azamgarh. I had more business from Varanasi than from Ahmedabad, right? So it just shows that if you have the reach, you can really get more and more investors into the industry. And we managed to add a lot of new investors. Which is why today, while our market share in terms of AUM is minuscule, we have a full 1% market share in terms of number of unique investors in the industry, right? So if with our size and our limited resources, we were able to achieve this, I think, there is tremendous scope to expand. So our strategy, going back to your original question, we were very focused on adding more investors, reaching out to places where others were not there. So that worked very well, which is how we survived those years. The next part of the journey, after our foreign partner pulled out and we had another partner, and we became open architecture, and then the challenges were very different. Then we are competing in a sense with everybody else in the market, and we had different challenges. So one thing which we wanted to be known was, rather than differentiating ourselves on the basis of products, because see, honestly, there is no copyright. Anything that you do, even before you launch your product, somebody else can copy if it's a good idea. So we wanted to be process-centric. We said the only thing, to borrow from Rajiv, see, we focus on what is in our control. What was in our control was the process. See, I can't guarantee what will be our rank, what will be our returns, etc. Nobody knows. We run as fast as we can. But, we said we will tell you how we select stocks, how we create portfolios, how we manage risk, and what exactly we are trying to achieve. So, for example, our fund managers are not incentivized to be in Q1. We say consistently be in Q2 or Q1. Q1 and Q2 have equal weightage. So nobody has that incentive to take extra risk or achieve anything in the short term. So we said we will stand for that. Now how that works, I'll just give you an example. Okay, in March 2020, we launched our mid-cap fund. And as described in the earlier panel, that was a very difficult time for the market. Market was falling. And our process was that we will not try to time the market, right? We will not stay in cash. All our equity funds at all points of time will be fully invested. If you want us to take cash calls, asset allocation calls, come to asset allocation products like BAF, right? So in an NFO, the day we get the money for investment, 1 or 2 days, we'll deploy the whole money. People got really nervous. They said, in this market, are you going to deploy 100% of funds, that to mid-cap? We said, that's our process, and we will do that. Now, as it turns out, the first day when we had the money to invest was 23rd March 2020. Right? 23rd March and 24th March, we deployed the whole money. Now, did we know that was the bottom of the market? We had no clue. We knew that this is what we were supposed to do. Okay, if we are expected to be consistently above average, we have to be in the market. You can't be consistently above average by taking cash calls. So this is what we said we will be known for, right? Entire last year, we were probably the only one or maybe one of the very few AMCs who did not launch any NFO. We said market is expensive. Our view is that it's very expensive. So we will not launch NFO, right? So now it comes at a cost, right? There is a cost of missing business. But we said, let us be known for this. There are so many things that we lack, like a brand, size, reach, marketing budget, all that we lack. But this is a long-term journey. Asset management is not a short-term game. So if you want to build a reputation and a name for yourself, we said, let's do it, the way we work, the process that we adopt, and hopefully it will show results and we'll be known for that. So that has been our approach.
Fair enough. I have one or two related questions on what you said, but before that, Ajit.
So Mahalakshmi, first I'll start with a correction that PGIM is the 10th largest asset manager in the world, and we are here. When you look at daily NAV, products all across the world, we are the 10th largest. And we've, been committed through the journey, despite the crises that we have been through in the past. It's a 145-year-old brand, of course, but in India, the journey is about just, 10 or 12 years old. And I think that, for us, while as a team now I can look back at the crisis and say we steered ourselves pretty well, I think the question that you ask, which is that, can you really differentiate? I think you can. I did hear Navneet in the earlier panel talk about the fact that you sometimes don't necessarily need to differentiate on the product. You can differentiate in your communication. And you can differentiate on facilities that you have and the service that you have. So for us, I think some of the guiding things that we've been doing to differentiate ourselves is I think that we try to be better storytellers. I think where we come from is that...
That's the job of media. Don't put us out of business.
Well, you can come to us for some good stories. But, there's a nuance here. Yes, the world is run by stories, but it's run by authentic stories. It is run by stories that feel genuine. It is run by stories that are backed up by evidence and facts as well. So we don't try to tell the story from an entertaining perspective, but it is about thinking about the science underlying our industry and our business. I think that today, a large portion of most stakeholders are stuck in 1952, when Harry Markowitz wrote his portfolio theory paper. And then you had Eugene Fama and you had William Sharp writing about capital pricing models. We think about man as an economic man making rational choices if you put all the numbers in front of him. And then came the Daniel Kahnemans and the Richard Thalers and the Muir Statmans to tell you that, listen, it's not the numbers. Yeah. It is behavior. It is behavioral biases. It's feelings that matter when people take money decisions. I think at PGIM India, what we've probably managed to do a little better than average is to connect the dots on how can we build sustainable behavior, starting within the company, of building trust, of being transparent to build that trust, of thinking through with the customer in the center, as Sandeep was saying, on many of how we construct the stories on. For instance, as Pradeep mentioned, we believe as a multinational that process is at the heart of everything. But to translate that process into a story that can be told within less than a minute, because the attention span of the general human being is, evidence to be less than a goldfish at 8 seconds. So how do you can't get market share if you can't get mind share. And mind share comes from the stories which are genuine and authentic. I think we've managed to do that as part of how we've built ourselves so far. We do think that every industry goes through 3 phases. The first phase is when distribution is king. The second phase is when investors gain more awareness and the product becomes king. And the third phase is when the product becomes commoditized, when the brand becomes king. We went through the first phase where the only discussions we did were commissions or foreign trips. Right. Try and sell our products and ideas. That happened. I think we made awareness a big part across the country, and then the product became king. For me, that product that became king is SIP. There are people who say, "Maine SIP kiya, mutual fund nahi," and they don't realize it's become that strong. 2018, SEBI's done this categorization and rationalization, as you call it, and the product has now become a commodity, which means brand is king. I think that every small AMC can, whether you are an advisor or a mutual fund or a wealth manager, I don't think size matters if you really got the ambition and the execution and the talent on your side.
Sure. So 2 points, execution, then differentiation not only through products, and you talked about onboarding first-time investors through a unique channel, a bank channel. So that's the question I wanted to really veer to, because that brings us to the larger question of viability of business. Because it's one thing to say that, of course, you said you're proud of the fact that you have 1% share of unit holders, which is quite an accomplishment for a new player. But at what cost? Because acquiring small accounts into tier 2, tier 3 cities is a costly business. It requires patience, time, capital at a time when fees structures are not as they were earlier. So in terms of viability, how do you think about it?
I think I can answer this in very short. So this will be this year 2023, FY 2023, I think for the 5th year in a row, we will be making profits. At an AUM, which we have just crossed 10,000 crores, we are profitable. So it's doable. Now you just need to see what works for us may not work for somebody else. Everybody needs to find, the niche where, where they can make a difference and where they can be sort of, more efficient. For us, it really helped the fact that, we had a bank network with us, which was able to reach, forget B30, B100 kind of places where, we were the only player, right? So conversations were easier. And I have challenged people very often, in various informal forums. Give me a genuine investor, somebody who has actually got money to invest. I am willing to bet that I can convert that person and get her to invest in mutual funds. Because we have a fantastic product, right? Mutual funds is great. It's a question of, can you have more conversations? Can you reach out to more people, right? We managed to reach out to more people in a cost-efficient way, right? So it worked. So we sold simple products. So I'll tell you about, the product part. So some of the things that we have consciously stayed away. We have never launched a sector fund, right? Because we believe the kind of audience that we have is not really ready for sector funds. Because, see, we all, with all due respect to all the players, I'm telling you what works for us, what we did. See, we all launch typically sector funds when the sector story is very hot and it will work for some time. But nobody goes and tells the investor that, the story is over now after whatever, 1 year or 2 years, now you move out. This conversation never happens, and we have seen this with IT funds, pharma funds, infra funds, n number of times we have seen finally investors leaving funds with disappointment. See, why I say disappointment? Because for an investor, in my view, what really matters ultimately is the day she sells, what is she getting? Your historic NAV, outperformance and all doesn't matter. When you redeem, what are you getting is a question. And very often people end up redeeming at the wrong time and go with a poor experience. So for that reason, given our audience, we thought we can't handle this. So we didn't launch sector funds, right? Unless we can find a theme or a sector which is sustainable in the long term, we will not do it. So I think some of these calls need to be taken because it may come at the cost of business. Now, if we had launched some of the sector funds, maybe we would have raised more money. But that's a call we had to take. So yeah, I think, smaller investors, onboarding them, it takes effort, need not be expensive. You just need to, find your own strengths. What works for me may not be what works for Ajit.
Fair enough. What is the golden AUM for viability? He said he's already making profits, but in terms of return on capital, you've grown Nippon from where to where?
So I think broadly, let's first let me say the revenues and the profitability of the asset management companies will be under pressure. I think it will come on 3 accounts. A, investor not willing to pay so much, regulatory, or competition, on all the 3. Now which is going to happen first, which is going to be second, we don't know. But which leads us to the point it's very important to have a very light structure because the structures of past may not work. The second most important thing is, many times the business models are built. I think this industry also has one thing which is good and I feel not so good. We only talk about AUM. I mean, even your punchline talks about 100 trillion. I think somehow, we need to move away from this to the number of investors. I wish next time, you, Kazad, when you do the next year event, you have this thing that every Indian household is a mutual fund investor and the topic for the 30 crore investors. I think that's the way. And why I say this is, that is going to, many times when we see the profitability of AMC, it is also dependent on what type of investors you have. Now, the retail investors give you stability. I remember when we launched the first SIP of 100 rupees, people said, I think it's not viable. But when we had 30 lakh investors investing, even if it's 100 rupees, it does not matter. So I think to this point, industry is going to be under pressure. I think if the revenue is concerned, the point that I see is going to be, I would say, I don't want to let everybody on his own, but if you want a scalable business, I think a 20,000 crores AUM is something that you look at that is sustainable. But one thing that is very important, we talked about the unit holder, we talked about the returns, we talked about everything. There's another aspect that we forget. There is also a shareholder. And why your question on profitability is very, very critical. The long-term interest of the shareholder to continue in India or to continue the business and not to sell the business is also dependent on how much return on equity that shareholder is making. And so your question is also, there's a third angle to it. So the profitability is definitely under pressure and scale is the only solution to that.
Sure. Scale is the only solution to that. How far do you see yourself running in the next 5 years?
See,
like coming back to, focus on what's in our control. Okay. So, and there are three things that we, believe that we can control and we can manage very well is, number one, focus on costs. Okay, stay light as possible without damaging future prospects. So it's not, you're not controlling costs at the cost of the future. You're basically putting in place enough capacity to grow, but at the same time being very, very cognizant of the fact that you don't want to be, to build cost to a level where you will collapse under the weight. That's number one. Number two, focus on processes. Okay, we get our processes right, and that's very important for us as rule-based investors, as factor-based investors, to get our investment processes right. If we get our investment processes right, we get all our other ancillary processes right, we are bound to get it right over the long term. Where the short term really doesn't matter. Performance over 1 year, 3 years is, again, 3 years is reasonably long, but performance over a year really doesn't count for anything. And lastly, what we believe in very, very strongly is that asset management is a boring business. It's supposed to be boring. It's supposed to be about doing the right thing unfailingly, day after day after day. Anyone who tries to make this business exciting is bound to fail. That is my takeaway from it. About close to 3 decades in the industry, as long as you focus on getting it right.
Fair enough. Keep it boring.
That's
the mantra.
Keep it boring. Okay, just do the right thing day after day after day, and that's what will hold you in good stead over a long period of time.
Sure. Ajit, you can have the last
word.
I'm sort
of lucky to have a partner, a foreign partner, a large partner with deep pockets, to keep investing into the business, because their view and this is something that I find very encouraging, is never to ask me the question about what's happening this quarter or this year. Really,
this is what I was about to ask you, that, like Goldman Sachs, has PGM given you a target in terms of when they're going to review, whether they want to remain in India or not?
They have resoundingly at least confirmed, even in the press, in Bloomberg and elsewhere, that they're going to be investing more into India. Fortunately, I think we've done well over the recent years to give them the confidence that we can grow organically. They are not averse to growing inorganically as well, if the right opportunity presents itself. But I think when I have seen my internal discussions, and I've been at 2 multinational brands, it's always a question of relevance first. It's also a question of profit being an outcome of something that you have to first get right, which is consistent performance with a very, very good process. And for that, you need people. So the things that I've learned, and coming from the multinational brands that I worked, is that this is a people's business first. You've got to get the talent right. Once you get the talent right and you've got your process right, as Pradeep was also mentioning, I think the profit outcome is reasonably sure. It may take time. For instance, we've crossed 20,000 in MFs, but we are not profitable yet. We should be maybe in the next 12 months. We will get there. So for me, the target's been of relevance. So for us, it was the target of saying, listen, if you want to be relevant, you need to at least be in the top 20 to begin with in the 3 years since we started the journey 3 years ago, and then aim for the next leg. And that can come even inorganically. Now, we had gone all the way down to 29th or 30th. We are back at 21. In 2.5 years' time. We've had fantastic support. 80% of our assets comes from MFDs. Right? We've not had national distributors or private banks pick us up at the early stage, because all of them have filters and criteria for right reasons. Right. And now we're getting there. So we've got a long runway. I think the direction of the business as the international partner or the sponsor sees it is fantastic. So they're willing to commit further. We've got a couple of licenses, not just mutual funds to run. We've got the PMS, we've got the AIF, we've got international advisory. And all of them don't get counted in assets, but is reasonably profitable. So you have other ways of participating in the market. Sure. When you raise the first question about international brands having gone out of India, and I have no idea, they could all have had their own reasons, obviously, to do that. But I've also felt that in many conversations that I've had, that you don't need to be a mutual fund player for a financial brand to participate in the growth story of India. right? You can participate in public-private partnerships with the government. There are projects. There are, there are various ways of participating into the growth story of India. So I don't think that we can brush them off. Yes, they may not have got some of the execution right in some cases, but they have the deep pockets to come in and grow the market further, which is good for everybody. There's also an element of the evolution of our industry in terms of regulation and transparency, by the way. Transparency more important than even, of course, the regulation matters. So PGIM, we are the 4th largest in the world in real estate. It's a fact that even I didn't know till 4 years ago, and we've got a global real estate product which is innovative and differentiating in the marketplace. They have not invested into India yet. And the reason is that many of the regulations that make real estate transparent are very, very new. And they're looking at 20 years of data where they can predict occupancy rates and rental yields before they can even start. So a lot of these reasons we've done extremely well as a country. And I think all kudos to the regulator as well, that even while we think it's swung, the pendulum on regulation swung a lot and that it's hard, it's helped make everything more transparent. I was at a recent discussion, small digression on this and I'll stop, is where I had a good market specialist say, do you know what's happened with FASTag? Right? What FASTag has done is it's made data on Indian roads so transparent that large pension funds are now willing to come and fund infrastructure in India, which they were not willing 5 years ago. Because the data is so transparent in terms of what's the usage of that asset, which we never had before. And there are pension funds I have heard personally talking about the fact we have the money, we can't see the project. Show us the project. So I think that there are various reasons here for multinationals. We are quite confident that the profitability will come if the input is right, which is more to do with consistent performance, risk-adjusted performance, good talent, and participating, as Sandeep said, across the spectrum to let the customer choose what he would want from us.
Fair enough. On that note, I'm getting a lot of looks from my colleagues because we've really overshot time. So on that optimistic note, you said PGIM has reaffirmed its belief and keeping patience in India. And I hope that becomes the inspiration for a lot of other global mutual funds to come to India and execute well and take all the tips that all these gentlemen have had to give. Thank you so much. It was a lovely discussion. Thank you for your patience.
Thank you. Thank you, Madam.
Guys, we have one more session left. Request you to take your seats so that we can get started with it real quick. All right. Thanks, Mahalakshmi, for a couple of engaging sessions. And that brings us to the last session of the evening. We've heard from industry leaders, financial experts, and even a finfluencer. But our next guest does not conform to just one sector, designation, or occupation. Vikas Khanna is an Indian chef, restaurateur, author, filmmaker, and a humanitarian. He's a judge of the Indian television show, Indian version of MasterChef, and has hosted 4 seasons of the show, Twist of Taste on Fox Life. Mr. Khanna's restaurant in New York was awarded a Michelin star for 6 consecutive years since its opening. He has also authored 39 books so far, including Sacred Foods of India, which was launched earlier this year as a phygital NFT. Mr. Khanna has produced a documentary series named Holy Kitchens and has directed the critically acclaimed film The Last Color. His latest documentary, Barefoot Empress, chronicles the journey of 100-year-old Kartyayani Amma, who went to school for the first time at the age of 96. And not to forget, during the COVID-19 pandemic, his initiative, Feed India, delivered over 85 million meals across the country. Please put your hands together for the ever multi-talented Vikas Khanna as he shares his thoughts with us on investing in $1 billion aspirations. Please come on stage.
Hi, good evening, everyone. We're just finishing the taping of MasterChef, so we just ran all the way from mud. I'm sorry, I'm not sure if I'm late. It's an honor to be here. I just heard the previous session. Investing in aspirations, when the subject came to me, I got really confused because my first investment I ever made was in a small banquets in 1990. I wasn't sure what we were doing. We had a small place behind our house. And I asked my grandfather, can I take that place? Because I thought I was very good in cooking. I was very young. I was like 18, 19 years old. And he said, yeah, you can take it, but what will you do with this open space? There wasn't enough money. And me and my grandmother used to give food to a school close by. So हमने principal से पूछा कि how can we make some money? And she says, oh, winter is coming. We need 600 or 700 sweaters. Can you make it for us? So all people who think that why do I take so many risks, that was a day I actually confined to something very strange. As a boy, summer vacation, in my 10th grade, I figured out how to knit a sweater from my grandmother. And I hand knit, I'm very proud of it, not ashamed. And I made almost 10,000 rupees in 1990. I invested in buying 24 chairs. I bought 2 patilas. My father gave me a big tandoor. And we were in business. And that was the first time I realized that if you do not take a risk, there is no way for you to be entitled to any glory. There's no last names. There's no big names behind me. I did most of it myself with my mom and my grandmom standing behind me. The banquet was a total failure, and I'm very proud of it. Because first of all, we spelled the name wrong. If somebody's from Punjab, they can really understand what I'm saying. Lawrence Garden spells Gardn. And Lawrence Street is still, they spelled the whole street wrong. And we were happy, we were doing business. But one thing which you realize is that was one of the biggest trainings I ever had in my entire life. I figured out that there's no investment without a consumer. If ladies would come and they will see me, I was very young and like so much energy. We had so many parties, but me and my grandmother would say, doesn't it seem a little guilty to ask people for money for food? I'm like, wow, that's right actually. So my father said that they would make fun of me, that we should call it charity. We shouldn't call it a business. But that planted a seed in my mind that I need to get educated. It is very interesting to speak about investments without thinking about the value. If you bring value to people, you own them for the rest of your life. And you continue to do that. I studied in hotel management. My biggest thing was that I was in Bombay for so many years of training. I went back to those banquets. There was a small room. There was a kitchen without a roof. I changed everything. And I did make a lot of money on Indian weddings and all. Then one day I said that, I'm giving value to people's weddings, but actually as a brand, I have no value. So I decided to move to US in 2000. And I've been there since then. But I do form a bridge between India and American culture, being one of the few people in this world who's hosted 4 American presidents and almost every relevant world leader except for Putin. And I do feel that the training of investment begins right from home. It begins right what you're taught, that you got to take this risk. I got to take this risk of moving to world's largest and the greatest and the most powerful and the richest city in the world. But if not being able to add value to the city, I would not have a value to myself. For anyone who is an aspiring investor, a talent, an artist, you need to first invest in yourself. all the money I made in America in the first few years, beginning years, I invested it all for my education. It was very important for me to study from the top American universities, because one day, after almost 2 decades, I'll be standing in here and talking about this. That investment is necessary, which is a part of becoming your value. You stand in front of the world leaders, and many of the firsts which I did in America were only based on because I was constantly investing in myself. And that sometimes sounds narcissist, but I figured out that if we need to make India as a much bigger brand, we need to find ways to invest in our artists. I never want to project myself as just a businessman. I do invest a lot in strange things, like almost a $4 million was invested in a culinary museum. What was the reason of that? It was to bring value to old Indian antiques from the kitchens. And the thing is so highly valued in some parts of the world, especially in America, where they would think, why would you contain to make a museum? I could have opened 4 restaurants in that money. But I chose to develop a way where I can have an ecosystem of my next generation and much generations after me to understand the intelligence of India. India was the first country to create alloys of combining metals. But we don't have any place for our kids to see that. Disney will soon come and open a museum about how they made Mickey Mouse, and they'll earn so much money. But I feel that my investment strategies are totally different. I figured out how to make those things work. I need to find a way to make culinary schools where I don't charge, I don't even teach, I don't tell them what culinary education, but I feel that I can empower those people who work there, who study there, to make them understand that hospitality is the second highest employer in the world after farming. Highest. And still we've invested so little in creating great infrastructures for our hotels, our restaurants, our now caterings, our food bloggers. That's all a part of hospitality. What has changed in the last few years absolutely is the existence of something like MasterChef. It gave India the word chef. We called Maharajas, we called Bawarchis, we were called everything, but cooks, but we were never called a chef. I've decided that I should find a way to come to India and find a way to be part of this show, which is a revolution, because grassroots change is the true change of the foundation. You can't be investing into a business where people do not even know what's the difference between being a chef and being just somebody who's doing bulk cooking. I figured out that's important for me. And then I also figured out, living in America, that I have a strange voice between 2 countries. I need to find ways to tell Indian stories. And when people say that my career confuses them, I said, think about being in my position. I always feel I haven't done enough for my country. So what you do, we start making movies. India is the only country which can claim of something like holy kitchens, where we connect foods and gods. There's no other culture in this world which speaks so loudly that how you can understand our religion, our faith, our people, our history through food. That series was amazing because it went to Ivy League schools. What was my investment in that for? My investment was that people, when they speak about India, they get a unique way of looking at us. Investment in the brand India, which we so sometimes overlook. I remember when Wisconsin Gurdwara, there was a shooting of Sikh. There were like 7 Sikhs was shot dead. I don't forget these things because I take them very personally. And media will take one news shot and they'll move on to the next sensationalized news. I didn't stop. I went to the White House. I spoke to President Obama's team. I said, we need to do something to make understanding of who Sikhs are, who Indians are. And an entire tour started around US on these things. Our next generation will never even know about these things which happened, for that big shift happening. And now then came the power of this entire concept of my obsession and total passion about widows. Why do I need to put so much money into making movies? If anybody has seen Last Color, it's on Amazon Prime with Neena Gupta, in which I figured out to get onto American Congress, to the mainstream stages, and talk about these issues so that it's easier for us to get funding so that we can empower those women and get them out of poverty. Most of the pandemic, my book sales and all these initiatives were helping all these widows to survive, to sustain, to endure the pandemic, the loneliness, from clothes to medications, to health supplements, to food. Everything came from all these initiatives. If these investments are not relevant, then I think I do not know any relevant investments on this. And now starts the whole initiative of education through Barefoot Empress. It is on YouTube. Please watch my film. It's now in the campaigning for Oscars. It's called Barefoot Empress on YouTube. And you'll be inspired that what am I doing with initiative of education around girls. I want to thank everyone for pushing me of these initiatives, because I feel investing in these things, I think it's much more important for me to bring a multi-chain restaurants and everything when I can support the grassroots change in education. I'm very thankful for this opportunity to speak to you. Thank you. Different kind of investments. Thank you. I go back.
What a brilliant way to bring an end to the first edition of Moneycontrol Mutual Fund Summit. Thank you so much, guys. Just before we let you all go, want to reiterate, the summit was co-presented by KFin Technologies, Associate Partner Reliance Industries Limited, Exhibit Partner Abhi Loans and Event Partners, Mirae Assets, Canara Robeco MF, Union MF, White Oak Capital MF, FundsIndia.com and Edelweiss MF. A big thank you to all the guests and panelists who took time out and joined us today, and a big thank you to all our viewers. India's mutual fund industry is well on its mark, well on its way to cross that 100 trillion mark, and everything is just adding up to it. Thank you so much for joining in.